Course title, ACC 206, Introduction to Cost and Management Accounting. Module 1, Basic Principles of Cost and Management Accounting. Unit 1, Nature, Scope, and Functions of Cost Accounting. 1.0 Introduction. In this unit, we shall be discussing the nature, scope, and functions of cost accounting. Cost accounting is a process of collecting, analyzing, summarizing, and evaluating various alternative courses of action. Its goal is to advise the management on the most appropriate course of action, based on the cost efficiency and capability. Cost accounting provides the detailed cost information that management needs to control current operations and plan for the future. 2.0 Objectives. After studying this unit, you should be able to describe the nature of cost accounting, describe the scope of cost accounting, and outline the functions of cost accounting. 3.0 Main content. 3.1 Nature of cost accounting. Let us discuss the nature of cost accounting under the following headings. 1. Cost accounting is a branch of knowledge. Though cost accounting is considered as a branch of financial accounting, it is one of the important branches of knowledge, that is, it is a discipline by itself. It is an organized body of knowledge consisting of its own principles, concepts, and conventions. These principles and rules vary from industry to industry. 2. Cost accounting is a science. Cost accounting is a science as it is a body of systematic knowledge relating to not only cost accounting but relating to a wide variety of subjects such as law, office practice, and procedure, data processing, production and material control, etc. It is necessary for a cost accountant to have intimate knowledge of all these fields of study in order to carry on his day-to-day activities. But it is to be admitted that it is not a perfect science as in the case of natural science. 3. Cost accounting is an art. Cost accounting is an art in the sense it requires the ability and skill on the part of cost accountant in applying the principles, methods, and techniques of cost accountancy to various management problems. These problems include the ascertainment of cost, control of costs, ascertainment of profitability, etc. 4. Cost accounting is a profession. In recent years, cost accounting has become one of the important professions which have become more challenging. This view is evident from 2 facts. First, the setting up of various professional bodies such as the Institute of Chartered Accountants of Nigeria, ICAN, in Nigeria, National Association of Accountants, NA, in USA, the Institute of Cost and Management Accountants in UK, the Institute of Cost and Works Accountants in India, and such other professional bodies both in developed and developing countries have increased the growing awareness of costing profession among the people. Secondly, a large number of students have enrolled in these institutes to obtain certificates and memberships for earning their livelihood. Self-assessment exercise. In your own words, describe cost accounting as a branch of knowledge. 3.2 Scope of cost accounting. The scope of cost accounting is very wide. There are lots of techniques, tools, procedures, processes, programs used in cost accounting for calculating cost and its control. But basically, we will divide its scope into 3 major parts. 1. Cost ascertainment. In this region of cost accounting collects products, material, labor, and overhead cost and try to calculate total and per unit cost of product. This total cost calculation will be based on historical or standard or estimated basis. After this, cost accountant will use any method of costing like specific order costing, operation costing, and direct costing technique. These techniques and methods may be used for calculating different nature products in the same organization. 2. Cost records. In this part of cost accounting, cost accountant maintains cost books, vouchers, ledgers, reports, and other cost-related documents for future comparison and reference. It will also be under the scope of cost accounting to ensure proper records are kept. 3. Cost control. This appears to be the boundary in describing the scope of cost accounting. In this division, cost accountant used different techniques and methods for controlling the cost. So, cost accountant uses budgetary control, standard costing, break-even point analysis and many other techniques for controlling the cost. Self-assessment exercise. Mention and describe the 3 areas in which the scope of cost accounting could be classified. 3.3 Function of cost accounting. The main functions of cost accounting are: 1. To serve as a guide to price fixing of products. 2. To disclose sources of wastage in process of production. 3. To reveal sources of economy in production process. 4. To provide for an effective control on factors of production. 5. To exercise effective control on factors of production. 6. To ascertain the profitability of each product. 7. To suggest management of future expansion policies. 8. To present and interpret data for management decisions. 9. To organize cost reduction programs. 10. To facilitate planning and control of business activity. 11. To supply timely information for various decisions, and 12. To organize the internal audit systems. Self-assessment exercise. Outline 5 functions of cost accounting. 4.0 Conclusion. Cost accounting systems and reports, unlike financial accounting that is expected to keep to the rules and standards, are not subject to rules and standards like the generally accepted accounting principles. Consequently, there is wide variety in the cost accounting systems of the different companies and sometimes even in different parts of the same company or organization. 5.0 Summary. In this unit, you would recall that we discussed the nature, scope, and functions of cost accounting. We described the nature of cost accounting as a branch of knowledge, as a science, as an art and as a profession. You would recall that we stated that although the scope of cost accounting is wide, we describe the scope of cost accounting by classifying it into 3 categories, which are cost ascertainment, cost record, and cost control. We concluded by outlining the functions of cost accounting. 6.0 Tutor marked assignment. 1. Describe the nature of cost accounting, and 2. State 10 functions of cost accounting. 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 2, nature, scope, and functions of management accounting. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Nature of management accounting. 3.2 Scope of management accounting. 3.3 Functions of management accounting. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. In this unit, we shall be discussing the nature, scope, and functions of management accounting. Management accounting is concerned with the provisions and use of accounting information to managers within organizations, to provide them with the basis to make informed business decisions that will allow them to be better equipped in their management and control functions. 2.0 Objectives. After studying this unit, you should be able to describe the nature of management accounting, describe the scope of management accounting, and explain the functions of management accounting. 3.0 Main content. 3.1 Nature of management accounting. 1. No fixed norms followed. In financial accounting, we follow different norms and rules for creating ledgers and other account books. But there is no need to follow fixed norms in management accounting. Management accounting tool may be different from one organization to other organization. Using of different tools of management accounting is fully dependent on the persons who are using it. So, business policy of each organization affects rules and regulation of applying management accounting. 2. Increase in efficiency. It is the nature of management accounting that it is used for increasing in the efficiency of organization. It scans the points of inefficiency through analysis of accounting information. By taking action for improving, organization can increase the efficiency. 3. Supplies information, not decisions. Management accountant supplies accounting facts and information and also provides interpretation, but decision-making is fully dependent on higher authorities. Management accounting is just guide. 4. Concerned with forecasting. It is the temperament of management accounting that it is fully concerned with forecasting. In management accounting, historical accounting information is analyzed through common size financial statement, ratio analysis, fund flow analysis, and accounting data tendency for knowing the probability of next fact. So, all these things are especially useful for forecasting. These forecasting may be related with following things. A. Sales forecasting. B. Production forecasting. C. Earnings forecasting. D. Cost forecasting. Self-assessment exercise. Mention and explain 2 features to describe the nature of management accounting. 3.2 Scope of management accounting. The scope or field of management accounting is very wide and broad-based, and it includes a variety of aspects of business operations. The main aim of management accounting is to help management in its functions of planning, directing, controlling, and areas of specialization included within the ambit of management accounting. The scope of management accounting can be studied as follows. 1. Financial accounting. Financial accounting forms the basis for analysis and interpretation, for furnishing meaningful data to the management. The control aspect is based on financial data and performance evaluation, on recorded facts and figures. So, management accounting is closely related to financial accounting in many respects. 2. Cost accounting. Cost accounting is the process and techniques of ascertaining cost, planning, decision-making. and control are the basic managerial functions. The cost accounting system provides the necessary tool for carrying out such functions efficiently. The tools include standard costing, inventory management, variable costing, etc. 3. Budgeting and forecasting. Budgeting means expressing the plans, policies, and goals of the firm for a definite period in future. Forecasting, on the other hand, is a prediction of what will happen as a result of a given set of circumstances. Forecasting is a judgment, whereas the budgeting is an organizational object. These are useful for management accounting in planning. 4. Inventory control. Inventory is necessary to control from the time it is acquired till its final disposal, as it involves large sum. For controlling inventory, management should determine different level of stock. The inventory control technique will be helpful for taking managerial decisions. 5. Statistical method. Statistical tools not only make the information more impressive, comprehensive and intelligible, but also are highly useful for planning and forecasting. 6. Interpretation of data. Analysis and interpretation of financial statements are important part of management accounting. After analyzing the financial statements, the interpretation is made and the reports drawn from this analysis are presented to the management. Interpreting the accounting data to the authorities in the management is the principal task of management accounting. 7. Reporting to management. The interpreted information must be communicated to those who are interested in it. The report may cover profit and loss account, cash flow, and funds flow statements, etc. 8. Internal audit and tax accounting. Management accounting studies all the tax matters to assist the management in investment decisions vis-a-vis tax planning as a resource to enjoy tax relief. Internal audit system is necessary to judge the performance of every department. Management is able to know deviations in performance through internal audit. It also helps management in fixing responsibility of different individuals. 9. Methods of procedures. This includes maintenance of proper data processing and other office management services. It may have to deal with filing, copying, duplicating, communicating and management information system, and also may have to report about the utility of different office machines. Self-assessment exercise. Mention and describe 5 aspects of business operations that management accounting may relate with. 3.3 Functions of management accounting. The basic function of management accounting is to assist the management in performing its functions effectively. The functions of the management are planning, organizing, directing and controlling. Management accounting helps in the performance of each of these functions in the following ways. I. Provides data. Management accounting serves as a vital source of data for management planning. The accounts and documents are a repository of a vast quantity of data about the past progress of the enterprise, which are a must for making forecasts for the future. 2. Modifies data. The accounting data required for managerial decisions is properly compiled and classified. 4. Example, purchase figures for different months may be classified to know total purchases made during each period product-wise, supplier-wise and territory-wise. 3. Analyses and interprets data. The accounting data is analyzed meaningfully for effective planning and decision-making. 4. This purpose the data is presented in a comparative form. Ratios are calculated and likely trends are projected. 4. Serves as a means of communicating. Management accounting provides a means of communicating management plans upward. downward and outward through the organization. Initially, it means identifying the feasibility and consistency of the various segments of the plan. At later stages, it keeps all parties informed about the plans that have been agreed upon and their roles in these plans. V. Facilitates control. Management accounting helps in translating given objectives and strategy into specified goals for attainment by a specified time and secures effective accomplishment of these goals in an efficient manner. All this is made possible through budgetary control and standard costing, which is an integral part of management accounting. 6. Uses also qualitative information. Management accounting does not restrict itself to financial data for helping the management in decision-making, but also uses such information which may not be capable of being measured in monetary terms. Such information may be collected from special surveys, statistical compilations, engineering records, etc. Self-assessment exercise. Mention and explain 5 functions of management accounting. 4.0 Conclusion. In contrast to financial accounting information, management accounting information is primarily forward-looking, instead of historical. Model-based with a degree of abstraction to support decision-making generically, instead of case-based. Designed and intended for use by managers within the organization, instead of being intended for use by shareholders, creditors, and public regulators. Usually confidential and used by management, instead of publicly reported. Computed by reference to the needs of managers, often using management information systems, instead of by reference to general financial accounting standards. 5.0 Summary. In this unit, you would recall that we discussed the nature, scope, and functions of management accounting. The nature of management accounting was described based on no fixed norm followed, increased inefficiency, supplies information not decisions, and concerned with forecasting. The scope of management accounting relates with financial accounting, cost accounting, revaluation accounting, budgetary control, inventory control, statistical methods, interim reporting, taxation, office services, and internal audit. We also discussed the function of management accounting, as management accounting helps to provide data, modifies data, analyses, and interprets data, serves as a means of communication, facilitates control, and finally uses qualitative information. 6.0 Tutor marked assignment. The basic function of management accounting is to assist the management in performing its functions effectively. What are the functions that management accounting help to perform? 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 3, Cost Accounting versus Management Accounting. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Branches of accounting. 3.2 Difference between cost and management accounting. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. In this unit, we shall be discussing accounting as segmented parts. When you hear the word accounting, most often what comes to mind is financial accounting. If you are asked to explain accounting, it is normal to expect you to start explaining what you understand as accounting, based on financial accounting. As time passes, accounting has evolved to show various segments of accounting as a piece of knowledge that demands attention. It would be in the light of this unit to describe various branches of accounting and most specifically state the difference between cost and management accounting as simple as possible. 2.0 Objectives. After studying this unit, you should be able to describe the branches of accounting, and state the difference between cost and management accounting. 3.0 Main content. 3.1 Branches of accounting. There are 7 branches of accounting. A. Financial accounting. This is called original accounting, which is mainly confined to the preparation of financial statements for the various concerned parties and financial institutions. B. Cost accounting. The process of accounting for cost, which begins with the recording of income and expenditure or the basis on which they are calculated and ends with the preparation of periodical statements and reports for ascertaining and controlling cost. C. Management accounting. Management accounting is a distinctive form of resource management which facilitates management's decision-making by producing information for managers within organization. D. Inflation accounting. This accounting system does not consider the cost constant at every time because the prices of a commodity change with time due to inflation and decline purchasing power of money. E. Social accounting. This deals with the application of double-entry system of bookkeeping to socio-economic analysis at the preparation, estimation, and interpretation of nation and international income and balance sheet. F. Value-added accounting. In this system, income is measured by the value added by a firm in a particular period. It is the difference between the value of the product and the cost of raw material, stores, and any brought out component used for production. G. Human resource accounting. Human resource accounting is the measurement of the cost and value of people for the organization, or it is the process of identifying and measuring data about human resources and communicating this information to interested parties. Self-assessment exercise. In few sentences describe the term value-added accounting. 3.2 Difference between cost accounting and management accounting. Usually the terms cost accounting and management accounting are used interchangeably and are used in one and the same sense. However, there are differences between these two terms, conceptually and in application. Cost accounting, which is sometimes also referred to as cost method of accounting, involves forecasting the cost per unit of a good or service. The per unit cost derivation is not restricted to 1 unit of good, but is also used to compute the expenditure of running one line of production, calculation of materials consumed by one machine, etc. The different expenditures that are involved in production of every unit are computed. Management accounting is the recording, regeneration, planning, and analysis of incomes and expenditures. It is basically a financial management function. Management accounting is done to provide a certain logical money-based mathematics to managerial decisions. It thus involves comparison, analysis, and business logic to process information regarding transactions. Simply put, management accounting is about getting the information from cost accountants and then uses it for decision-making purposes. Practically speaking, cost accounting involves computation of cost per unit with different angles. For example, cost accounting in a steel mill will principally involve the computation of cost of 1 ton of steel. For this, a foreman's salary that contributed to the production of that ton of steel is computed. The coke, power, workman's salary, premises, and factory machinery cost are some other items that are adding to prime costs, cost of raw material, which in this case is iron and other metals. Management accounting goes one step forward, and makes a further comparative analysis and statements of figures that are derived by financial accounting and costing. Other managerial accounting functions include the analysis of every possible transaction and projecting the trend of transactions. Basically, management accounting functions deal with internal and external forces of transactions that influence the business's entity, to find out answers to the questions such as what is the monetary productivity of the factory, or how costly has raw material become, or what can we cut down on costs, or how can we maximize profit, or where does the market or our competitors stand. Having discussed the difference between cost accounting and management accounting, let us outline in simple terms some of the differences between cost and management accounting. 1. Cost accounting deals with ascertainment, allocation, apportionment accounting aspect of costs. Management accounting deals with the effect and impact of costs on the business. 2. Cost accounting provides a base for management accounting, whereas management accounting is derived from cost accounting and financial accounting. 3. Cost accounting does not include financial accounting, tax planning, and tax accounting. Management accounting includes financial and cost accounting, tax accounting, and tax planning. 4. Cost accounting is concerned with short-term planning. Management accounting is concerned with short-range and long-range planning. 5. Cost accounting merely assists the management with functioning. Management accounting assists and evaluates the management performance. 6. Cost accounting can be installed with management accounting, but management accounting cannot be installed without cost and financial accounting. Self-assessment exercise. Outline 4 differences between cost accounting and management accounting. 4.0 Conclusion. Cost accounting supports management accounting, and management accounting in turn pushes cost accounting further according to the needs of the management. Because of this strong tie between cost accounting and management accounting, they appear to show a relationship stronger than what other branches of accounting have. 5.0 Summary. In this unit, we discussed the topic cost accounting versus management accounting. This topic was discussed under 2 subunits, which are the branches of accounting and the difference between cost accounting and management accounting. You would recall that accounting has 7 branches, which are financial accounting, cost accounting, management accounting, social accounting, inflation accounting, value-added accounting, and human resources accounting. Cost accounting deals with calculation and measurement of resources utilized for different business activities, usually production and service provision. It relates to calculation of per unit cost using different costing techniques. On the other hand, management accounting relates to the use of all such information gathered and processed by cost accounting by management. Management accounting is about getting the information from cost accountants and then uses it for decision-making purposes. 6.0 Tutor marked assignment. 1. Mention and describe 4 branches of accounting. 2. State 4 differences between cost accounting and management accounting. 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 4, Principles underlying the preparation and presentation of cost accounts for various types of business. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 The purpose of cost. 3.2 Essentials of cost accounting system. 3.3 Advantages of cost accounting. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. In this unit, we shall be discussing some of the principles underlying the preparation and presentation of cost accounts for various types of business. We shall be discussing the purpose of costing in order to be familiar with the idea of cost and costing, the essentials of cost accounting system and the advantages of cost accounting. This is to help you appreciate the principles and concepts facilitating the preparation and presentation of cost accounts in various organizations. 2.0 Objectives. After studying this unit, you should be able to explain the purpose of costing, mention and describe the essentials of cost accounting system, and state the advantages of cost accounting various interested parties. 3.0 Main content. 3.2 The purpose of costing. Costing serves number of purposes, among which the following are considered to be most important. 1. Ascertainment of cost. This was considered to be the primary objective of cost accounting in the initial stages of its development. However, in modern times this has assumed the secondary objective of cost accounting. Cost ascertainment involves the collection and classification of expenses at the first instance. Those items of expenses which are capable of charging directly to the products manufactured are allocated. Then the other expenses which are not capable of direct allocation are apportioned on some suitable basis. Thus the cost of production of goods manufactured is ascertained. In this process, cost accounting involves maintenance of different books to record various elements of cost. Cost of production is ascertained by using any of the costing technique, such as historical costing, marginal costing, etc. 2. Cost control. At one time cost control was considered as secondary objective of cost accounts. But in modern times it constitutes the primary purpose because of its utmost importance in all business undertakings. Cost control is exercised at different stages in a factory, viz., acquisition of materials, recruiting and deployment of labor force, during the production process and so on. As such, we have material cost control, labor cost control, production control, quality control, and so on. However, control over cost is exercised through the techniques of budgetary control and standard costing. The control techniques enable the management in knowing the operating efficiency of a business. 3. Determination of selling price. Every business organization aims at maximizing profit. Total cost of production constitutes the basis on which selling price is fixed by adding a margin of profit. Cost accounting furnishes both the total cost of production as well as cost incurred at each and every stage of production. No doubt other factors are taken into consideration before fixing price, such as market conditions, the area of distribution, volume of sales, etc. But cost plays the dominating role in price fixation. 4. Frequent preparation of accounts and other reports. The management of every business constantly relies upon the reports on cost data in order to know the level of efficiency relating to purchase, production, sales and operating results. Financial accounting provides information only at the end of the year because closing stock value is available only at the end of the year. But cost accounts provide the value of closing stock at frequent intervals by adopting a continuous stock verification system. Using the value of closing stock, it is possible to prepare final accounts and know the operating results of the business. 5. To provide a basis for operating policy. Cost data to a great extent helps in formulating the policies of a business and in decision making. As every alternative decisions involve investment of capital outlay, costs play an important role in decision making. Therefore, availability of cost data is a must for all levels of management. Some of the decisions which are based on cost are: A. Make or buy decision, B. Manufacturing by mechanization or automation, C. Whether to close or continue operation in spite of losses. Self-assessment exercise. Explain the purpose of costing. 3.3 Essentials of cost accounting system. The following are the essentials of an ideal cost accounting system. 1. Accuracy. The system of cost accounting must provide for accuracy in terms of both cost ascertainment and presentation. Otherwise it will prove to be misleading. 2. Simplicity. Cost accounting system involves detailed analysis of cost. To avoid complications in the procedure of cost ascertainment, an elaborate system of costing should be avoided and every care must be taken to keep it as simple as possible. 3. Elasticity. The costs accounting system should be capable of adapting itself to the changing situations of business. It must be capable of expansion or contraction depending upon the needs of the business. 4. Economy. The cost of operating costing system must be less. It must result in increased benefit when compared to the expenditure incurred in installing it. 5. Comparability. The records to be maintained must facilitate comparison over a period of time. The past records must serve as a basis to guide the future. 6. Promptness. An ideal costing system is one which provides cost data in an analytical form to the management. So all the departments of a factory must analyze and record the relevant items of cost promptly in order to furnish cost information on a regular basis to various levels of management. This helps in checking up the progress of the business on a regular basis. 7. Periodical preparation of accounts. With a view to facilitate the comparison of results frequently, it is desirable to prepare accounts periodically. Constant comparison of actual result with standard result enables to spot out areas of inefficiency. This can be set right by taking remedial measures. 8. Reconciliation with financial accounts. The system of cost accounts must be capable of reconciling with financial accounts so as to check accuracy of both the system of accounts. 9. Uniformity. The various forms and documents used under costing system must be uniform in size and quality of paper. Printed forms must be used to avoid delay in the preparation of reports. This also reduces the burden of clerical staff. Forms of different colors can be used to distinguish different documents. 10. Equity. The basis of apportioning indirect expenses to products, departments, or jobs must be fair and equitable. Self-assessment exercise. Mention and describe 5 essentials of cost accounting system. 3.4 Advantages of cost accounting. A good costing system serves the needs of a large section of people. The advantages of cost accounting are discussed below. Advantages of cost accounting to management. 1. Fixation of responsibility. Whenever a cost center is established, it implies establishing a kind of relationship between superior and subordinates. Thus, responsibilities are fixed on every individual who is concerned with incurrence of cost. 2. Measures economic performance. By applying cost control techniques such as budgetary control and standard costing, it helps in knowing the performance of business. 3. Fixation of price. By providing cost data, it helps management to fix the selling price in advance. Hence, quotations can be supplied to prospective customers to secure orders. 4. Aids in decision making. It helps management in making suitable decisions such as make or buys, replace manual labor, buy machines, shut down or continue operations based on cost reports. 5. Helps in the preparation of interim final accounts. By the process of continuous stock taking, it enables to know the value of closing stock of materials at any time. This facilitates preparation of final accounts wherever desired. 6. Helps in minimizing wastages and losses. Cost accounting system enables to locate the losses relating to materials, idle time, and utilization of plant and machinery. 7. Facilitates comparison. It facilitates cost comparison in respect of jobs, process, and departments, and also between two periods. This reveals the efficiency or otherwise of each job, process, or department. 8. Assists in increasing profitability. Costing reports provide information about profitable or unprofitable areas of operation. The management can discontinue that product line or those departments which are responsible for incurring losses, and only profitable line of activities alone are retained. 9. Reconciliation with financial accounts. A well-maintained cost accounting system facilitates reconciliation with financial accounts to check the arithmetical accuracy of both the systems. 10. It guides future production policy. Cost data help management in determining future production policy. Any expansion or contraction of production for the future is based on past cost data. Advantages of cost accounting to employees. 1. Cost accounting system enables employees to earn better wages through overtime wages and incentive systems of wage payment. 2. By providing better facilities, it ensures job security to employees. 3. Employees benefit by merit rating techniques, which is conducted by scientific process. Advantages of cost accounting to creditors. 1. It increases the confidence of creditors in the capital employed in the business. 2. The frequent preparation of reports and statements help in knowing solvency position of the business. Advantages of cost accounting to government. 1. It helps government in formulating policies regarding export, import, taxation, price control measures, wage fixation, etc. 2. It helps in assessing excise duty, sales tax, and income tax of the business. 3. Costing information helps in preparing national plans. Advantages of cost accounting to society. 1. Cost reduction and cost control programs go to minimize cost of production of goods and services. A portion of the reduced cost of production is shared by customers by paying lesser price for goods and services. 2. It offers employment opportunities in the cost accounting department in the capacity of cost accountants and cost clerks. Self-assessment exercise. Outline 3 advantages of cost accounting as it relates to the government. 4.0 Conclusion. Accounting principles serve as bases in preparing, presenting, and interpreting of financial data. They provide a foundation to prevent misunderstandings between and among the preparers and users of such accounting information. 5.0 Summary. In this unit, you would recall that we discussed the principles underlying the preparation and presentation of cost accounts for various types of business. We discusses the purpose of costing, the essentials of cost accounting system and the advantages of cost accounting as it affects various interest groups. 6.0 Tutor marked assignment. What are the advantages of cost accounting to the management of an organization? 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Module 2 Cost Concepts. Unit 1 Different meanings of cost. Unit 2 Cost Unit and Cost Center. Unit 3 Elements of cost. Unit 4 Classification of cost I. Unit 1 The different meanings of cost. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Cost concept. 3.2 Types of cost. 3.3 Cost for planning and control. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further. 1.0 Introduction. In this unit, we shall be discussing the different meanings of cost, starting with the concept of the word cost to make it easier to understand the different types of cost. 2.0 Objectives. After studying this unit, you should be able to define cost in business and accounting. Describe cost from the viewpoint of the buyer and seller. Identify various types of cost, and describe different types of cost. Explain cost for planning and control. 3.1 Cost concept. What is cost? In business and accounting, Cost is the monetary value that a company has spent in order to produce something. Cost denotes the amount of money that a company spends on the creation or production of goods or services. It does not include the markup for profit. From a seller's point of view, cost is the amount of money that is spent to produce a good or a product. If a seller sold his products at the production price, he would break even, meaning that he would not lose money on his sales. However, he would not make a profit either. From a buyer's point of view, the cost of a product can be called the price. This is the amount that the seller charges for a product, and it includes both the production cost and the markup cost, which is added by the seller in order for him to make a profit. Cost in accounting. In accounting, the term cost refers to the monetary value of expenditures for raw materials, equipment, supplies, services, labor, products, etc. It is an amount that is recorded as an expense in bookkeeping records. Planning for costs. When a new company's business plan is developed, organizers will often create cost estimates. These are used to assess whether the benefits and revenues of a proposed business will more than cover the costs. This is called a cost-benefit analysis. Self-assessment exercise. From the viewpoint of the seller, what is cost? 3.2 Types of cost. Fixed costs, FC, these are the costs which do not vary with changing output. Fixed costs might include the cost of building a factory, insurance, and legal bills. Even if your output changes or you do not produce anything, your fixed costs stay the same. Variable costs, VC, these are costs which depend on the output produced. For example, if you produce more cars, you have to use more raw materials such as metal. This is a variable cost. Semi-variable cost. Semi-variable cost is an expense which contains both a fixed cost component and a variable cost component. The fixed cost element shall be a part of the cost that needs to be paid irrespective of the level of activity achieved by the entity. On the other hand, the variable component of the cost is payable proportionate to the level of activity. Labor might be a semi-variable cost. If you produce more cars, you need to employ more workers, this is a variable cost. However, even if you did not produce any car, you may still need some workers to look after empty factory. Total costs, TC, total cost is the combination of fixed cost and variable costs. Marginal costs, marginal cost is the cost of producing an extra unit. If the total cost of producing 2 pairs of shoes is N1,600, and the total cost of producing 3 pairs of shoes is N1,900. The marginal cost of the third pair of shoes is 300. Economic cost. Economic cost includes both the actual direct costs, accounting costs, plus the opportunity cost. For example, if you take time off work to a training scheme which may cost you a deduction of N3,000 from your salary because your organization does not approve such absenteeism, and you are required to pay direct cost N15,000 for that training scheme. The economic cost for that training scheme would N3,000 plus N15,000, making a total of N18,000. Economic costs are related to future. They play a vital role in business decisions as the costs considered in decision making are usually future costs. They have the nature similar to that of incremental, imputed explicit, and opportunity costs. Accounting costs, This is the monetary outlay for producing a certain good. Accounting costs will include your variable and fixed costs you have to pay. Avoidable costs, these are costs that can be avoided. If you stop producing cars, for instance, you do not have to pay for extra raw materials and electricity. Sometimes this is known as an escapable cost. Actual cost. Actual cost is defined as the cost or expenditure which a firm incurs for producing or acquiring a good or service. The actual costs or expenditures are recorded in the books of accounts of a business unit. Actual costs are also called as outlay costs or absolute costs or acquisition costs. Examples are cost of raw materials, wage bill, etc. Opportunity cost. Opportunity cost is concerned with the cost of foregone opportunities/alternatives. In other words, it is the return from the second best use of the firm's resources which the firm foregoes in order to avail of the return from the best use of the resources. It can also be said as the comparison between the policy that was chosen and the policy that was rejected. The concept of opportunity cost focuses on the net revenue that could be generated in the next best use of a scarce input. Opportunity cost is also called as alternative cost. If a firm owns a land, there is no cost of using the land, i.e. the rent, in the firm's account. But the firm has an opportunity cost of using the land, which is equal to the rent foregone by not letting the land out on rent. Another example is if you invest 1 million naira in developing a farm camp, the opportunity cost is that you cannot use that money to invest in developing food processor. Sunk cost. Sunk costs are those do not alter by varying the nature or level of business activity. Sunk costs are generally not taken into consideration in decision making as they do not vary with the changes in the future. Sunk costs are a part of the outlay/actual costs. Sunk costs are also called as non-avoidable costs or inescapable costs. For example, all the past costs are considered sunk costs. The best example is amortization of past expenses, like depreciation. Incremental cost. Incremental costs are addition to costs resulting from a change in the nature of level of business activity. As the costs can be avoided by not bringing any variation in the activity, they are also called avoidable costs or escapable costs. Moreover, incremental costs resulting from a contemplated change in the future are also called differential costs. For example, change in distribution channels, adding or deleting a product in the product line. Explicit cost. Explicit costs are those expenses/expenditures that are actually paid by the firm. These costs are recorded in the books of accounts. Explicit costs are important for calculating the profit and loss accounts and guide in economic decision-making. Explicit costs are also called paid-out costs. For example, interest payment on borrowed funds, rent payment, wages, utility expenses, etc. Implicit cost. Implicit costs are a part of opportunity cost. They are the theoretical costs. That is, they are not recognized by the accounting system and are not recorded in the books of accounts but are very important in certain decisions. They are also called the earnings of those employed resources, which belong to the owner himself. Implicit costs are also called imputed costs. For examples, rent on idle land, depreciation on dully depreciated property still in use, interest on equity capital, etc. Book cost. Book costs are those business costs which do not involve any cash payments, but a provision is made in the books of accounts in order to include them in the profit and loss account and take tax. Advantages, like provision for depreciation and for unpaid amount of the interest on the owner's capital. Out-of-pocket costs. Out-of-pocket costs are those costs which are current payments to the outsiders of the firm. All the explicit costs fall into the category of out-of-pocket costs. For example, rent paid, wages, salaries, interest, etc. Accounting costs. Accounting costs are the actual or outlay costs that point out the amount of expenditure that has already been incurred on a particular process or on production. And as such, accounting costs facilitate for managing the taxation need and profitability of the firm. For example, all sunk costs are accounting costs. Direct cost. Direct costs are those which have direct relationship with a unit of operation, like manufacturing a product, organizing a process or an activity, etc. In other words, direct costs are those which are directly and definitely identifiable. The nature of the direct costs is related with a particular product/process. They vary with variations in them. Therefore, all direct costs are variable in nature. It is also called traceable costs. For examples, in operating railway services, the costs of wagons, coaches and engines are direct costs. Indirect costs. Indirect costs are those which cannot be easily and definitely identifiable in relation to a plant, a product, a process, or a department. Unlike the direct costs, indirect costs do not vary. That is, they may or may not be variable in nature. However, the nature of indirect costs depends upon the costing under consideration. Indirect costs are both the fixed and the variable type, as they may or may not vary as a result of the proposed changes in the production process, etc. Indirect costs are also called non-traceable costs. For example, the cost of factory building, the track of a railway system, etc., are fixed indirect costs, and the costs of machinery, labor, etc. Self-assessment exercise. Explain the term opportunity cost. 3.3 Costs for planning and control. Controllable cost. The terminology of CIMA defines controllable cost as a cost which can be influenced by the action of specified member of an undertaking. It refers to those costs which may be regulated at a specified level of authority, management, within a specified time period. The term controllable costs means variable costs. Cost control factor depends on time factor and level of managerial authority. If the time period is sufficiently long, cost can be well controlled. Proper delegation of authority with responsibility facilitates the task of control of costs. Uncontrollable costs. Uncontrollable cost is defined as the cost which cannot be influenced by the action of a specified member of an undertaking. This cost is not subject to control at any level. The difference between the terms is important for the purpose of cost control and responsibility. Accounting costs which are not subject to the control of a person should not be charged to that person. For instance, a foreman should not be charged with the plant superintendent's salary. The foreman should be charged only with such items as usage of materials, direct labor, supplies. Further, it must be noted that the distinction between controllable and uncontrollable cost is not absolute. It is made in relation to a given member of an organization. A cost which is considered uncontrollable by a manager can be controlled by a higher official. Examples of uncontrollable cost: rent, salary of staff, depreciation. Budget: a budget is a plan for a future period. It is expressed in monetary terms. The terminology of SEMA defines a budget as a plan quantified in monetary terms, prepared and approved prior to a defined period of time, usually showing planned income to be generated and or expenditure to be incurred during that period and the capital to be employed to attain a given objective. It is also a tool of control. Standard costs: standard costs are closely related to budgets, and both are said to be complementary to each other. It is a basic accounting tool. A standard cost is a predetermined calculation of how much costs should be under specific working conditions. It is built up from an assessment of the value of cost elements and correlates technical specifications and quantification of material, labor, and other costs to the prices and or wage rates expected to apply during the period in which standard cost is intended to be used. Its main purposes are to provide basis for control through variance accounting, for valuation of stock and work in progress, and in some cases, for fixing selling prices. Self-assessment exercise. What is the meaning of standard cost? 4.0 Conclusion. At this point, let us conclude this unit by defining cost accounting again to emphasize the concept of cost and types of cost. Cost accounting is the process of collecting information about the costs incurred by a company's activities, assigning selected costs to products and services and other cost objects, and evaluating the efficiency of cost usage. It is mostly concerned with developing an understanding of where a company earns and loses money, and providing input into decisions to generate profits in the future. 5.0 Summary. In this unit, we discuss the different meanings of cost. We discuss the concept of cost and the various definitions of cost which describe the different types of cost. 6.0 Tutor marked assignment. Mention and describe 10 types of cost that you know. 7.0 References / further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 2, Cost Unit and Cost Centers. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Cost Unit. 3.2 Cost Center. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References / further reading. 1.0 Introduction. You would recall that we discussed the different meanings of cost in the previous unit. In this unit, we shall discuss cost unit and cost center. 2.0 Objectives. After studying this unit, you should be able to Explain cost unit, and explain cost center. 3.0 Main content. 3.1 Cost unit. While preparing cost accounts, it becomes necessary to select a unit with which expenditure may be identified. The quantity upon which cost can be conveniently allocated is known as a unit of cost or cost unit. The Chartered Institute of Management Accountants, CIMA, London defines a unit of cost as a unit of quantity of product, service, or time in relation to which costs may be ascertained or expressed. Unit selected should be unambiguous, simple, and commonly used. Following are the examples of units of cost. I. Brickworks per 1,000 bricks made. 2. Collieries per ton of coal raised. 3. Textile mills per yard or per pound of cloth manufactured or yarn spun. 4. Electrical companies per unit of electricity generated. V. Transport companies per passenger km. 6. Steel mills per ton of steel made. Self-assessment exercise. Explain the term cost unit. 3.2 Cost center. According to the Chartered Institute of Management Accountants, London, cost center means a location, person, or item of equipment, or group of these, for which costs may be ascertained and used for the purpose of cost control. Thus, cost center refers to one of the convenient units into which the whole factory or an organization has been appropriately divided for costing purposes. Each such unit consists of a department, a sub-department, or an item or equipment or machinery, and a person or a group of persons. Sometimes, closely associated departments are combined together and considered as one unit for costing purposes. For example, in a laundry, activities such as collecting, sorting, marking, and washing of clothes are performed. Each activity may be considered as a separate cost center, and all costs relating to a particular cost center may be found out separately. Cost centers may be classified as follows: productive, unproductive, and mixed cost centers. Personal and impersonal cost centers. Operation and process cost centers. Productive cost centers are those which are actually engaged in making products, service, or unproductive cost centers do not make the products but act as the essential aids for the productive centers. The examples of such service centers are as follows: Administration Department, Repairs and Maintenance Department, Stores and Drawing Office Department. Mixed cost centers are those which are engaged sometimes on productive and other times on service works. For example, a tool shop serves as a productive cost center when it manufactures dies and jigs to be charged to specific jobs or orders, but serves as servicing cost center when it does repairs for the factory. Impersonal cost center is one which consists of a department, a plant, or an item of equipment. Whereas a personal cost center consists of a person or a group of persons. In case a cost center consists of those machines or persons which carry out the same operation, it is termed as operation cost center. If a cost center consists of a continuous sequence of operations, it is called process cost center. In case of an operation cost center, cost is analyzed and related to a series of operations in sequence, such as in chemical industries, oil refineries, and other process industries. The objective of such an analysis is to ascertain the cost of each operation irrespective of its location inside the factory. 4.0 Conclusion. Cost unit is device for the purpose of breaking up cost into smaller subdivisions. Ordinarily, Cost unit is the expression in the form of count, weight, dimension, etc. Cost unit is the unit of measurement of different types of products. For example, ton in case or coal, yards in case of cloth, liter in case of petrol, etc. Cost centers are the smallest segment of activity or area of responsibility for which costs are accumulated or ascertained. Cost centers are the natural division of the organization into convenient units for the purpose of cost ascertainment and control. These are the department of the organization, but sometimes a department may also contain several cost centers. 5.0 Summary. In this unit, you would recall that we discussed cost unit and cost center. According to SEMA, cost unit was defined as a unit of quantity of product, service, or time in relation to which costs may be ascertained or expressed, while cost center was defined as a location, person, or item of equipment, or group of these, for which costs may be ascertained and used for the purpose of cost control. 6.0 Tutor marked assignment. What do you understand by the term cost center? 7.0 Reference/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 3, Elements of Cost. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Materials as an element of cost. 3.2 Labor as an element of cost. 3.3 Expenses as an element of cost. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. Management accounting techniques break costs into two major cost classifications: product costs, those costs related to manufacturing, and period costs, which are all non-manufacturing costs. Product costs are then broken down into the elements of cost. These elements, labor, materials and overhead, make up the cost of products at nearly every company. Understanding accounting cost classifications can help you make sure that you are accounting for production at your company in the correct manner. There are broadly three elements of cost: 1. Material, 2. Labor, and 3. Expenses. 2.0 Objectives. After studying this unit, you should be able to describe material as a cost element, describe labor as a cost element, and describe expenses as a cost element. 3.0 Main Content. 3.1 Materials as an element of cost. The substance from which the product is made is known as material. It may be in a raw state, raw material, example timber for furniture and leather for shoe, etc. It may also be in manufactured state components, example battery for car, speaker for radio, etc., materials can be direct and indirect. Direct material, all materials which become an integral part of the finished product, the cost of which are directly and completely assigned to the specific physical units and charged to the prime cost, are known as direct material. The following are some of the materials that fall under this category. A. Materials which are specifically purchased, acquired or produced for a particular job, order or process. B. Primary packing material, e.g. carton, wrapping, cardboard, etc. C. Materials passing from one process to another as inputs. In order to calculate the cost of material, expenses such as import duties, dock charges, transport, cost of materials are added to the invoice price. Material considered direct at one time may be indirect on other occasion. Nail used in manufacturing wooden box is treated as direct material, but treated as indirect material when used to repair the factory building. Indirect material, all materials, which cannot be conveniently assigned to specific physical units, are termed as indirect material. Such commodities do not form part of the finished products. Consumable stores, lubrication oil, stationery, and spare parts for the machinery are termed as indirect materials. Self-assessment exercise. What is direct material? 3.2 Labor as an element of cost. Human efforts used for conversion of materials into finished products or doing various jobs in the business are known as labor. Payment made towards the labor is called labor cost. It can also be direct and indirect. Direct labor is all labor expended and directly involved in altering the condition, composition, or construction of the product. The wages paid to skilled and unskilled workers for manual work or mechanical work for operating machinery, which can be specifically allocated to a particular unit of production, is known as direct wages or direct labor cost. Hence, direct wage may be defined as the measure of direct labor in terms of money. It is specifically and conveniently traceable to the specific products. Wages paid to the goldsmith for making gold. Ornament is an example of direct labor. Indirect labor, labor employed to perform work incidental to production of goods or those engaged for office work, selling and distribution activities are known as indirect labor. The wages paid to such workers are known as indirect wages or indirect labor cost. Example, salary paid to the driver of the delivery van used for distribution of the product. Self-assessment exercise. What is the difference between direct and indirect labor? 3.3 Expenses as an element of cost. All expenditures other than material and labor incurred for manufacturing a product or rendering service are termed as expenses. Expenses may be direct or indirect. Direct expenses, these are expenses which are specifically incurred and can be directly and wholly allocated to a particular product, job, or service are termed as direct expenses. Examples of such expense are carriage inward, royalty, interest on loan used in the manufacturing process, etc. These are also known as chargeable expenses. Indirect expenses, all expenses excluding indirect material and indirect labor, which cannot be directly and wholly attributed to a particular product, job, or service, are termed as indirect expenses. Some examples of such expenses are repairs to machinery, insurance, lighting and rent of the buildings. Self-assessment exercise. What are indirect expenses? 4.0 Conclusion. The three elements of cost are material, labor, and expenses. 5.0 Summary. In this unit, you would recall that we discussed the elements of cost. The three elements of cost are material, labor, and expenses. The substance from which the product is made is known as material. Human efforts used for conversion of materials into finished products or doing various jobs in the business are known as labor. All expenditures other than material and labor incurred for manufacturing a product or rendering service are termed as expenses. 6.0 Tutor marked assignment. Mention and explain the elements of cost. 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 4, Classification of Cost I. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Classification by change of activities. 3.2 Classification by association. 3.3 Classification by traceability. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. In this unit, we shall be discussing the classification of cost. Cost may be classified into different categories depending upon the purpose of classification. Some of the important categories in which the costs are classified are explained in the various subunits. 2.0 Objectives. After studying this unit, you should be able to explain fixed cost, variable cost, and semi-fixed cost. Explain product cost and period cost. Explain direct and indirect cost. 3.0 Main Content. 3.1 Classification by change of activities. Variable cost. The cost which varies directly in proportion with every increase or decrease in the volume of output or production is known as variable cost. Variable costs are sometimes referred to as direct costs in system of direct costing. Some of its examples are as follows. Wages of laborers. Cost of direct material. Power. In some circumstances, variable costs are classified into the following. Discretionary cost. Engineered cost. The term discretionary costs are generally linked with the class of fixed cost. However, in the circumstances where management has predetermined that the organization would spend a certain percentage of its sales for the items like research, donations, sales promotion, etc., discretionary costs will be of a variable character. Engineered variable costs are those variable costs which are directly related to the production or sales level. These costs exist in those circumstances where specific relationship exists between input and output. For example, in an automobile industry there may be exact specifications as 1 radiator, 2 fan belts, 1 battery etc. would be required for 1 car. In a case where more than 1 car is to be produced, various inputs will have to be increased in the direct proportion of the output. Thus, an increase in discretionary variable costs is due to the authorization of management, whereas an increase in engineered variable costs is due to the volume of output or sales. Self-assessment exercise. Distinguish between discretionary costs from engineering costs. Fixed cost. The cost which does not vary but remains constant within a given period of time and a range of activity in spite of the fluctuations in production is known as fixed cost. Some of its examples are as follows: rent or rates, insurance charges, management salary. Fixed costs are sometimes referred to as period costs in system of direct costing. Fixed costs can be further classified into committed fixed costs, discretionary fixed costs. Committed fixed costs consist largely of those fixed costs that arise from the possession of plant, equipment, and a basic organization structure. For example, once a building is erected and a plant is installed, nothing much can be done to reduce the costs such as depreciation, property taxes, insurance, and salaries of the key personnel etc. without impairing an organization's competence to meet the long-term goals. Discretionary fixed costs are those which are set at fixed amount for specific time periods by the management in budgeting process. These costs directly reflect the top management policies and have no particular relationship with volume of output. These costs can, therefore, be reduced or entirely eliminated as demanded by the circumstances. Examples of such costs are research and development costs, advertising and sales promotion costs, donations, management, consulting fees etc. These costs are also termed as managed or programmed costs. Self-assessment exercise. Explain the term committed fixed costs. Semi-variable cost. The cost which does not vary proportionately but simultaneously does not remain stationary at all times is known as semi-variable cost. It can also be named as semi-fixed cost. Some of its examples are as follows: depreciation, repairs. 3.2 Classification by association. Product costs. The costs which are a part of the cost of a product rather than an expense of the period in which they are incurred are called as product costs. They are included in inventory values. In financial statements, such costs are treated as assets until the goods they are assigned to are sold. They become an expense at that time. These costs may be fixed as well as variable, example cost of raw materials and direct wages, depreciation on plant and equipment etc. Period costs. The costs which are not associated with production are called period costs. They are treated as an expense of the period in which they are incurred. They may also be fixed as well as variable. Such costs include general administration costs, salaries, salesmen, and commission, depreciation on office facilities etc. They are charged against the revenue of the relevant period. Differences between opinions exist regarding whether certain costs should be considered as product or period costs. Some accountants feel that fixed manufacturing costs are more closely related to the passage of time than to the manufacturing of a product. Thus, according to them, variable manufacturing costs are product costs, whereas fixed manufacturing and other costs are period costs. However, their view does not seem to have been yet widely accepted. Self-assessment exercise. Explain product cost. 3.3 Classification by traceability. Direct costs. The expenses incurred on material and labor which are economically and easily traceable for a product, service, or job are considered as direct costs. In the process of manufacturing of production of articles, materials are purchased, laborers are employed and the wages are paid to them. Certain other expenses are also incurred directly. All of these take an active and direct part in the manufacture of a particular commodity and hence are called direct costs. Indirect costs. The expenses incurred on those items which are not directly chargeable to production are known as indirect costs. For example, salaries of timekeepers, storekeepers, and foremen. Also certain expenses incurred for running the administration are the indirect costs. All of these cannot be conveniently allocated to production and hence are called indirect costs. Traceable, untraceable, or common costs. The costs that can be easily identified with a department, process, or product are termed as traceable costs. For example, the cost of direct material, direct labor, etc. The costs that cannot be identified so are termed as untraceable or common costs. In other words, common costs are the costs incurred collectively for a number of cost centers and are to be suitably apportioned for determining the cost of individual cost centers. For example, overheads incurred for a factory as a whole, combined purchase cost for purchasing several materials in one consignment, etc. Joint cost is a kind of common cost. When two or more products are produced out of one material or process, the cost of such material or process is called joint cost. For example, when cotton seeds and cotton fibers are produced from the same material, the cost incurred till the split off or separation point will be joint costs. Self-assessment exercise. What are direct costs? 4.0 Conclusion. The classification of cost explained above does not show the totality of cost classification. We have earlier noted in the introduction that costs are classified according to the purpose for which the costs are made. Hence, further discussion of classification of cost would be seen in the next unit. 5.0 Summary. In this unit, you will recall that we discussed the classification of cost I, which focused on fixed cost, variable cost, semi-variable cost, period cost, product cost, direct and indirect cost. The cost which varies directly in proportion with every increase or decrease in the volume of output or production is known as variable cost. The cost which does not vary but remains constant within a given period of time and a range of activity in spite of the fluctuations in production is known as fixed cost. The cost which does not vary proportionately but simultaneously does not remain stationary at all times is known as semi-variable cost. The costs which are a part of the cost of a product rather than an expense of the period in which they are incurred are called as product costs. The costs which are not associated with production are called period costs. The expenses incurred on material and labor which are economically and easily traceable for a product, job, service are considered as direct costs. The expenses incurred on those items which are not directly chargeable to production are known as indirect costs. 6.0 Tutor marked assignment. Explain the following terms. A. Variable cost. B. Fixed cost. C. Product cost. D. Period cost. E. Direct cost, and F. Indirect cost. 7.0 References/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Unit 5, Classification of Cost 2. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Classification by Controllability. 3.2 Classification by Function. 3.3 Classification by Decision-Making Costs and Accounting Costs. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor Marked Assignment. 7.0 References/further reading. 1.0 Introduction. We have started discussing the classification of cost in the previous unit, where we discussed the classification by changes of activities, classification by association and classification by traceability. In this unit, we shall be discussing the completing part of classification of cost. In this unit, we shall be discussing the classification by controllability, classification by function and the classification by decision-making costs and accounting costs. 2.0 Objectives. After studying this unit, you should be able to explain production, administration, and selling and distribution costs. Explain controllable and uncontrollable cost. Explain shutdown and sunk cost. Explain relevant and irrelevant cost. Explain differential cost, and explain opportunity cost. 3.0 Main Content. 3.1 Classification by Controllability. Controllable and uncontrollable costs. Controllable costs are those costs which can be influenced by the ratio or a specified member of the undertaking. The costs that cannot be influenced like this are termed as uncontrollable costs. A factory is usually divided into a number of responsibility centers, each of which is in charge of a specific level of management. The officer in charge of a particular department can control costs only of those mat dollar which come directly under his control, not of other mat dollar. For example, the expenditure incurred by tool room is controlled by the foreman in charge of that section, but the share of the tool room expenditure which is apportioned to a machine shop cannot be controlled by the foreman of that shop. Thus, the difference between controllable and uncontrollable costs is only in relation to a particular individual or level of management. The expenditure which is controllable by an individual may be uncontrollable by another individual. Avoidable or escapable costs and unavoidable or inescapable costs. Avoidable costs are those which will be eliminated if a segment of a business, example a product or department, with which they are directly related is discontinued. Unavoidable costs are those which will not be eliminated with the segment. Such costs are merely reallocated if the segment is discontinued. For example, in case a product is discontinued, the salary of a factory manager or factory rent cannot be eliminated. It will simply mean that certain other products will have to absorb a large amount of such overheads. However, the salary of people attached to a product or the bad debts traceable to a product would be eliminated. Certain costs are partly avoidable and partly unavoidable. For example, closing of one department of a store might result in decrease in delivery expenses but not in their altogether elimination. It is to be noted that only avoidable costs are relevant for deciding whether to continue or eliminate a segment of a business. Self-assessment exercise. What are controllable and uncontrollable costs? 3.2 Classification by function. Production, administration, and selling and distribution costs. A business organization performs a number of functions, example production, selling and distribution, research and development. Costs are to be curtained for each of these functions. The Chartered Institute of Management Accountants, London, has defined each of the above costs as follows. I. Production cost. The cost of sequence of operations which begins with supplying materials, labor, and services, and ends with the primary packing of the product. Thus, it includes the cost of direct material, direct labor, direct expenses, and factory overheads. 2. Administration cost. The cost of formulating the policy, directing the organization and controlling the operations of an undertaking which is not related directly to a production, selling, distribution, research or development activity or function. 3. Selling cost. It is the cost of selling to create and stimulate demand, sometimes termed as marketing, and of securing orders. 4. Distribution cost. It is the cost of sequence of operations beginning with making the packed product available for dispatch and ending with making the reconditioned returned empty package, if any, available for reuse. V. Research cost. It is the cost of searching for new or improved products, new application of materials, or new or improved methods. 6. Development cost. The cost of process which begins with the implementation of the decision to produce a new or improved product or employ a new or improved method and ends with the commencement of formal production of that product or by the method. 7. Pre-production cost. The part of development cost incurred in making a trial production as preliminary to formal production is called pre-production cost. Self-assessment exercise. Explain the following terms. A. Production cost. B. Distribution cost. C. Development cost, and D. Administration cost. 3.3 Classification by decision-making costs and accounting costs. Decision-making costs and accounting costs. Decision-making costs are special-purpose costs that are applicable only in the situation in which they are compiled. They have no universal application. They need not tie into routine financial accounts. They do not and should not conform the accounting rules. Accounting costs are compiled primarily from financial statements. They have to be altered before they can be used for decision-making. Moreover, they are historical costs and show what has happened under an existing set of circumstances. Decision-making costs are future costs. They represent what is expected to happen under an assumed set of conditions. For example, accounting costs may show the cost of a product when the operations are manual, whereas decision-making cost might be calculated to show the costs when the operations are mechanized. Shutdown and sunk costs. A manufacturer or an organization may have to suspend its operations for a period on account of Some temporary difficulties, example shortage of raw material, non-availability of requisite labor etc. During this period, though no work is done yet certain fixed costs, such as rent and insurance of buildings, depreciation, maintenance etc., for the entire plant will have to be incurred. Such costs of the idle plant are known as shutdown costs. Sunk costs are historical or past costs. These are the costs which have been created by a decision that was made in the past and cannot be changed by any decision that will be made in the future. Investments in plant and machinery, buildings etc. are prime examples of such costs. Since sunk costs cannot be altered by decisions made at the later stage, they are irrelevant for decision making. An individual may regret for purchasing or constructing an asset, but this action could not be avoided by taking any subsequent action. Of course, an asset can be sold and the cost of the asset will be matched against the proceeds from sale of the asset for the purpose of determining gain or loss. The person may decide to continue to own the asset. In this case, the cost of asset will be matched against the revenue realized over its effective life. However, he/she cannot avoid the cost which has already been incurred by him/her for the acquisition of the asset. It is, as a matter of fact, sunk cost for all present and future decisions. Example: Jolly Limited purchased a machine for N30,000. The machine has an operating life of 5 years, without any scrap value. Soon after making the purchase, management feels that the machine should not have been purchased since it is not yielding the operating advantage originally contemplated. It is expected to result in savings in operating costs of N18,000 over a period of 5 years. The machine can be sold immediately for N22,000. To take the decision whether the machine should be sold or be used, the relevant amounts to be compared are N18,000 in cost savings over 5 years and N22,000 that can be realized in case it is immediately disposed. N30,000 invested in the asset is not relevant since it is same in both the cases. The amount is the sunk cost. Jolly Limited, therefore, sold the machinery for N22,000 since it would result in an extra profit of N4,000 as compared to keeping and using it. Relevant and irrelevant costs. Relevant costs are those which change by managerial decision. Irrelevant costs are those which do not get affected by the decision. For example, if a manufacturer is planning to close down an unprofitable retail sales shop, this will affect the wages payable to the workers of a shop. This is relevant in this connection since they will disappear on closing down of a shop. But prepaid rent of a shop or unrecovered costs of any equipment which will have to be scrapped are irrelevant costs which should be ignored. Imputed or hypothetical costs. These are the costs which do not involve cash outlay. They are not included in cost accounts but are important for taking into consideration while making management decisions. For example, interest on capital is ignored in cost accounts though it is considered in financial accounts. In case two projects require unequal outlays of cash, the management should take into consideration the capital to judge the relative profitability of the projects. Differentials, incremental or decrement cost. The difference in total cost between two alternatives is termed as differential cost. In case the choice of an alternative results in an increase in total cost, such increased costs are known as incremental costs. While assessing the profitability of a proposed change, the incremental costs are matched with incremental revenue. Out-of-pocket costs. Out-of-pocket cost means the present or future cash expenditure regarding a certain decision that will vary depending upon the nature of the decision made. For example, a company has its own trucks for transporting raw materials and finished products from one place to another. It seeks to replace these trucks by keeping public carriers. In making this decision, of course, the depreciation of the trucks is not to be considered, but the management should take into account the present expenditure on fuel, salary to drive dollar and maintenance. Such costs are termed as out-of-pocket costs. Opportunity cost. Opportunity cost refers to an advantage in measurable terms that have foregone on account of not using the facilities in the manner originally planned. For example, if a building is proposed to be utilized for housing a new project plant, the likely revenue which the building could fetch, if rented out, is the opportunity cost which should be taken into account while evaluating the profitability of the project. Conversion cost. The cost of transforming direct materials into finished products excluding direct material cost is known as conversion cost. It is usually taken as an aggregate of total cost of direct labor, direct expenses and factory overheads. Self-assessment exercise. What is conversion cost? 4.0 Conclusion. Like we have earlier discussed, the classification of cost is based on the purpose of the cost. We have discussed other costs as they would be classified. 5.0 Summary. In this unit, you would recall that we discussed classification of cost too. This unit was a continuation from the previous unit. We discussed classification by controllability, classification by function and classification by decision-making costs and accounting costs. 6.0 Tutor marked assignment. 1. Explain classification by function. 2. Explain the following terms. A. Opportunity cost. B. Differential cost, and C. Sunk cost. 7.0 Reference/further reading. Barfield, J.T., Rayborn, C.A. and Kinney, M.R., 1994. Cost Accounting, Traditions and Innovations. New York, New York, West Publishing Company. Eldenberg, L.G. and Wolcott, 2005. Cost Management, Measuring, Monitoring and Motivating Performance. United States of American, USA, Susan Elba. Lucy, T., 2009. Costing, 7th ed. United Kingdom, UK, Book Power. Warren, C.S., Reeve, J.M. and Fees, P.F., 1999. Financial and Managerial Accounting. United States of America, USA, International Thomson Publishing. Module 3 Costing Concepts. Unit 1 Accounting for Materials. Unit 2 Stock/Inventory Control. Unit 3 Accounting for Labor. Unit 4 Accounting for Overheads. Unit 5 Job and Process Costing. Unit 1 Accounting for Materials. Contents. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Basic Classification of Materials. 3.2 Stores, Functions and Activities. 3.3 Factors that facilitate effective material cost control. 3.4 Valuation of stock. 3.5 Stock management. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor Marked Assignment. 7.0 References/further reading. 1.0 Introduction. In manufacturing organizations, materials constitute over 60% of cost of production. 2. Minimize cost. Material cost control is germane to any organization that depends on materials for its production process. Some manufacturing organizations invest so much on research and development in other to proffer ways of obtaining the maximum and efficient use of their raw materials. This chapter, therefore, outlines mechanism for controlling material cost and provides a structure for determining material cost. 2.0 Objectives. After studying this chapter, you should be able to mention the basic classification of stocks, explain the basic functions and activities of the store, list the factors that facilitate effective material cost control, state the methods of stock valuation, differentiate between physical stock taking and periodic stock taking. 3.0 Main content. 3.1 Basic classification of materials. Materials, also referred to as stock, includes all the tangible material assets of an organization, other than its fixed assets. They consist of the following: A. Raw materials. B. Work in progress. C. Finished goods. D. Merchandise ready for sale. E. Any parts of materials to be incorporated into a finished product, component parts. F. Consumables such as stationery, oil card, grease, fuel, gas. G. Jigs, fixtures and special tooling. H. Byproduct, scrap. I. Work supplies and J. Packaging. 3.2 The stores, functions and activities. 3.2.1 Purchasing. A. Identifying and defining need for items of stores and supplies. B. Identifying and evaluating available suppliers of these items. C. Negotiating with selected suppliers, and D. Making contracts and placing orders for the needed items to be supplied. 3.2.2 Operating the store. A. Receiving and accepting, rejecting, the items ordered. B. Holding or keeping the items until they are used. C. Issuing out the items for use. 3.2.3 Stock control. A. Recording the stock. B. Checking stock. C. Planning replenishment of stock. D. Valuation of stock. 3.2.4 Summarized overview of stores functions. A. The purchasing function. I. Requisition for stock. 2. Supplier analysis and selection. Negotiation with suppliers and placing orders. B. Operating the store. I. Receipt of orders and 2. Materials handlings comprising holding stock, issuing stock for use. C. Stock control. I. Stock records. 2. Stock audits, and 3. Reordering of stocks. Self-assessment exercise. Explain the function and activities of the store. 3.3 Factors that facilitate effective material cost control. The following factors are important for an effective material control system: a budget of material usage and purchases, the handling of purchases by competent and qualified personnel, availability of sufficient and effective storage facilities, an effective classification and coding of materials, effective use of standard form for proper documentation, an effective coordination among all departments involved in materials handling, e.g., buying, receiving, storage and usage, the institution of a working internal control system/audit. 3.4 Valuation of stock. There is usually a challenge in ascertaining the price by which stock should be issued out of the Store because they are usually purchased at varying prices from time to time. There are several methods that could be employed to price issues. 3.4.1 Methods of valuing stock. A. First in first out, FIFO. B. Last in first out, LIFO. C. Simple average method, SAM. D. Weighted average method, WAM. E. Standard price. F. Replacement price. G. Specific identification. H. Retail method. Some of the objectives of material pricing are: A. To charge to producing on a consistent and realistic basis, the cost of materials used. B. To provide a satisfactory basis of valuing stock at the end of the period. Self-assessment exercise. What are the factors that facilitate effective material cost control? 3.5 Stock management. Stock management involves materials planning and material control. The major reasons why organizations engage in stock management is to avoid the negative effect of stock out and overstocking. Stock out is a situation where an organization has sufficient materials required for production. Overstocking is a situation where a business organization maintains more materials than is necessary at any given time. There are basically two ways to control stock. 1. Perpetual inventory system. 2. Physical stock taking. 3.5.1 Perpetual inventory system. This is a method of controlling physical stock level by ensuring that the amount of stock level of every item is accounted for at all times. This normally involves detailed recording of all receipts, issues and balances for each item of stock. Due to the detailed recording of all in and out, management does not need to do a physical stock taking/count. The stock level can be ascertained at any moment of time. To ensure that the stock level is accurate, physical stock taking needs to be conducted. 3.5.2 Physical stock taking. Basically, there are two types of physical stock taking. Continuous stock taking. The word continuous means the continual physical count of the quantity of the stock. This is done few times a year. The physical quantities counted are then compared to the stock recorded under the perpetual inventory system. Stock discrepancies between physically counted and recorded might be due to pilferage and falsification of documents, natural wastage like evaporation or breaking in bulk, warehouses errors both physical and clerical. Clerical errors in the books recorded under the perpetual inventory system. Periodic stock taking. Unlike continuous stock taking, the stocks are physically counted only at the end of the accounting year or period. 3.5.3 Advantages of continuous physical stock taking compared to periodic stock taking. Though the greatest disadvantage is the time and manpower factor as it involves more frequent stock taking, there are many advantages of continuous over periodic stock taking. It improves the quality of the physical stock taking as there are more frequent physical counting. It allows stock discrepancies to be more fully investigated. Maintain a higher work standards as the warehouse personnel know that they need to count the stock more frequently. Unauthorized changes in procedures are detected and production hold UPS, a common issue in periodic stock taking, are eliminated. 4.0 Conclusion. We have been able to discuss the management of materials in this unit. Materials could also be referred to as stocks, which are an important aspect of production. Care and caution should be taken when they are valued and during the stock taking process. 5.0 Summary. In this unit we have examined the basic classification of materials, functions, and activities of the stores, factors that facilitate effective material cost control, valuation of stock and materials. Management. 6.0 Tutor marked assignment. 1. Mention the basic classification of stocks. 2. Explain the basic functions and activities of stores. 3. List the factors that facilitate effective material cost control. 4. State the methods of stock valuation. 5. Differentiate between physical stock-taking and periodic stock-taking. 7.0 References/further readings. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Lucy, T. 1990. Costing. 3rd edition. Great Britain. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adeniji AA, 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures. Limited, Lagos, Nigeria. Lucy, T. 1994. Management Accounting. 3rd edition. Great Britain. Unit 2, Stock/Inventory Control. Contents. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Stock Control System. 3.1.1 Minimum Stock Level. 3.1.2 Maximum Stock Level. 3.1.3 Reorder Stock Level. 3.1.4 Economic Order Quantity. 3.1.5 Average Cost Level. 3.1.6 Safety Stock or Buffer Stock. 3.1.7 Lead Time. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. In the last unit we considered materials management and we looked at the various methods of taking stock. In this unit, we shall be considering the technique of controlling stock/inventory. Inventory control is one of the challenges of management. This is because they have to ascertain the level of stock to maintain in order to avoid stock out or overstocking. Management must make decisions on the levels of stock that will minimize cost and maximize the efficient use of available materials. 2.0 Objectives. At the end of this unit, you should be able to calculate the following stock levels. A. Minimum stock. B. Maximum stock. C. Reorder stock. D. Reorder stock quantity or economic order quantity, and E. Average stock. 3.0 Main Content. If stocks are too high, there would be excess capital tied up unproductively, high cost of storage, risk of deterioration, risk of changes in demand or technology will leave surplus stocks unusable. But then, if stocks are too low, there would be risk of interruption to production, high cost of frequent reordering and loss in economies resulting from bulk purchase. A proper system of control and recording of stocks must be instituted to prevent stocks lying around in heaps, thereby making it impossible to know the level of stock and control them. Also, if there is no control, cost of production will not be known, and this will mean that information required for other financial management decision will be incomplete. 3.1 Stock Control System. A proper system of stock control will have the following elements: physical security of stock in a lockable section controlled by a responsible storekeeper, diversified control of stock ordering, and usage by works personnel, issue and receipt by stores personnel, buying by the buying office, and payment by the accounting department, careful documentation of all stock movements and stock levels. In this unit we shall be considering the technique of ascertaining different stock levels. 3.1.1 Minimum stock level. This is the lowest level of the stock that is established by management. It is arrived at after considering the lead time and the demand for the materials. 3.1.2 Maximum stock level. This is the stock level that should not be exceeded without the permission of top management. 3.1.3 Reorder stock level. The reorder stock level is the level of inventory at which it becomes necessary to place order for new supply. Management must be watchful in order to know the quantity of stock to order and the timing of the supply. 3.1.4 Economic order quantity. Economic order quantity is the quantity of materials an organization will purchase at a time to enjoy economy of scale, i.e. transport cost, bulk discount, ordering cost, holding cost, etc. 3.1.5 Average cost level. This is the midway between the minimum stock level and the maximum stock level. 3.1.6 Safety stock or buffer stock. This is an additional stock held by an organization over and above the minimum stock. The provision is made against some errors in the demand estimate for the stock or abnormal delays in the lead time. 3.1.7 Lead time. This is the amount of time it takes for the material to be delivered from the supplier after an order has been placed. Self-assessment exercise. Briefly explain the following terms. A. Minimum stock level. B. Maximum stock level. C. Reorder stock level. D. Economic order quantity. E. Average cost level. Illustration 3:1. The following data relates to Better Life Manufacturing Company Ltd. with respect to material AZ7. 124,000 units of the material will be used every day for a 260 days year. 2. It will cost N100,000 to place each order. 3. The cost of 1 unit of AZ7 is N24,000 and it will cost 10% of this amount to hold each unit of AZ7 in store. 4. Daily usage of material AZ7 will not exceed 25,000 units and will not be less than 23,000 units. 5. The most reliable supplier takes a maximum period of 4 days to deliver, but the shortest period could be 2 days. Using the above data, calculate the following. A. Reorder level of stock. B. Minimum stock level. C. Reorder quantity / economic order quantity. D. Maximum stock level. E. Average cost level. Suggested solution 3:1. A. Reorder level of stock. Reorder stock level equals maximum usage x maximum delivery period. Maximum usage equals 25,000 units. Maximum delivery period equals 4 days. Reorder level equals 25,000 x 4 days equals 100,000 units. B. Minimum stock level. Minimum stock level equals reorder level, average usage x average delivery period. Reorder level equals 100,000 units. Average usage equals 24,000 units. I.E. 23,000 plus 25,000/2. Average lead time equals 3 days. Minimum stock level equals 100,000 unit, 24,000 units x 3 days. Equals 100,000 units, 72,000 units. Equals 28,000 units. See reorder quantity / economic order quantity. Economic order quantity EOQ equals, where D equals annual demand, CO equals cost of order, CC equals carrying cost per unit. Annual demand equals 24,000 units x 360 equals 8,640,000. CO equals cost of order equals 100,000. CC equals carrying cost per unit equals 2,400. EOQ equals. EOQ equals 26,832. 815 units. D maximum stock level. Maximum stock level is reorder level plus reorder quantity minimum usage x minimum delivery period. Reorder level equals 100,000 units. Reorder quantity equals 26,833. Minimum usage equals 23,000 units. Min delivery period equals 2. MSL equals 100,000 plus 26,833 to 23,000 x 2. MSL equals 126,833 to 46,000. MSL equals 80,833 units. E average stock level. Average stock level equals 4.0 Conclusion. The control of inventory in an organization cannot be overemphasized because organizations cannot afford to experience stock shortage or to be overstocked. Any of these situations could lead to direct or indirect losses. 5.0 Summary. In this unit we have been able to discuss stock control system in relation to minimum stock level, maximum stock level, reorder stock level and economic order quantity. 6.0 Tutor marked assignment. Oriental Hotels uses 10,000 cartons of red wine per annum. The carrying cost per unit of the cartons is N2.00 per carton and cost of order is N5,000.00 per order. Determine the economic order quantity. 7.0 References / further reading. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adeniji AA, 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures. Limited, Lagos, Nigeria. Lucy, T., 1994. Management Accounting. 3rd edition. Great Britain. Unit 3, Accounting for Labor. Contents. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Labor as a factor of production. 3.2 Division of labor and productivity. 3.3 Labor recruitment cost. 3.4 Selection process. 3.5 Labor timing and assessment. 3.6 Work study. 3.7 Labor cost computation. 3.8 Direct and indirect cost of labor. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References / further reading. 1.0 Introduction. Labor cost is present in all organizations. It is an unavoidable cost. Labor is the second element of cost, and one of the most important. It is believed that labor controls other elements of cost like materials and expenses. It is generally accepted that the success or failure of production of goods and services largely depends on the labor. Therefore, labor is a germane element in the production process. 2.0 Objectives. After studying this chapter, you should be able to define labor cost, explain labor as a factor of production, explain division of labor and productivity, explain what constitutes recruitment cost, explain the methods of labor timing and assessment, explain work study, compute labor cost using the various methods of remuneration, distinguish between direct labor cost and indirect labor cost, explain group incentive scheme. 3.0 Main content. 3.1 Labor as a factor of production. Labor cost is the human contribution to production process, and it requires regular evaluation, control and analysis. For an effective and efficient evaluation, control, and analysis of labor, there is the need for an organization to develop a good organization chart. Factors of production are resources or inputs that are used to facilitate the production of goods and service in an organization. Labor, which is the human contribution to the production process, is required to transform raw material into finished goods and services. Labor takes the form of employee knowledge, expertise, and experience. With these skills, production cannot take place. 3.2 Division of labor and productivity. It is generally believed that when labor is allocated amongst specialized units, it would lead to cost minimization, and that large-scale production is more beneficial than small-scale production. As a result of economies of scale and possibility of specialization. 3.2.1 Advantages of division of labor. Specialization leads to automation and computerization of the production process, which results in high productivity. Time is saved because the worker does not switch from one operation to another. Training time is reduced since a worker needs to know only his specific function. The workers, employer, and the whole organization would benefit from specialization, when each person can specialize in a particular skill. 3.2.2 Disadvantage of division of labor. Fatigue is likely to set in. The more specialized a worker is, the more the chances of becoming unemployed, if the demand for the particular type of skill diminishes. There is the danger of the part of some jobs being concentrated on particular individuals. 3.3 Labor recruitment cost. Recruitment is the process of identifying and attracting a pool of candidates, from which some will later be selected to receive employment offers. It is also referred to as a set of activities an organization uses to attract job candidates who have the abilities and attitude needed to help the organization achieve its objectives. 3.3.1 Types of recruitment. Decisions made during the recruitment process can go a long way to affect the productivity and efficiency of the organization. An organization can choose from the centralized or decentralized form of organization. 3.3.1.1 Centralized recruitment. The recruitment practices of an organization are centralized when the human resource, HR, department of the head office performs all the functions of recruitment. 3.3.1.2 Decentralized recruitment. This form of recruitment practice is commonly seen in the case of conglomerates operating in different and diverse business areas. With diverse and geographically spread business areas and office, it becomes important to understand the needs of each unit and arrange the recruitment Policies and procedures accordingly. Each business unit carries out its own recruitment. The following steps are usually taken. A job analysis is done to determine the role, responsibilities, and person specification required. Internally, an advert is placed on company notice board and a search conducted. Externally, consideration is given to various search options like labor office, newspapers, outsourcing, job fairs, executive searches, and so on. Applicants respond to company's invitation and the company proceeds to shortlist potential applicants. Self-assessment exercise. 1. What are the advantages and disadvantages of division of labor? 2. Explain the different types of recruitment. 3.4 Selection process. Interviews are conducted, whether structured or unstructured. A structured interview should have an agreed format with questions to evaluate applicants. The right candidate is selected using predetermined criteria. 3.5 Labor timing and assessment. After employees have been engaged and they begin to work, there is the need to time them as they work so as to assess their performance and also to make it possible to assign monetary value to the work that they do. Various organizations use different methods to time their employees. Examples of methods used included the following: the use of attendance register, the use of click cards, the use of attendance board, the use of job sheets and job books, etc. The above records will then be used as evidence of the number of hours worked by employees, the time spent by each employee on any job, the number of hours during which each employee was idle, etc. These will then form the basis for computing the wages of employees. 3.6 Work study. This is the system of increasing or maximizing the productivity of an operating unit by organizing the work of that unit. Work study is subdivided into two major methods, namely method study and work measurement. 3.6.1 Method study. This is the recording and critical examination of existing methods of doing work and comparing same with proposed methods with a view of coming up with easier methods which would be more effective and cheaper on the long run. 3.6.2 Work measurement. This seeks to measure the time required for a qualified worker to complete a specific assignment at a specified level of performance. 3.7 Labor cost computation. Labor cost can be computed using the following methods: I. Time-based remuneration. 2. Output-based remuneration. 3.7.1 Time-based method of remuneration. The amount earned by the employee is based on the number of hours spent at his place of work, and not on the quantity of work produced. The gross wage is calculated as hours worked x rate per hour. However, when overtime is worked, the payment to the employee will also include premium on the overtime hours. Illustration 3:1. Assume the following scenario. Number of hours worked equals 150 hours. Rate per hour equals N3500. Gross wage will be number of hours worked x rate per hour. 150 x N3500 equals N525, 000. 3.7.1.1 Advantages of time-based method of remuneration. It is simple to operate and easy to understand. The quality of work produced tends to be higher since the worker is not in a rush to complete a job in order to minimize his earnings. 3.7.1.2 Disadvantages of time-based method of remuneration. There is no financial incentive to produce more than a minimum amount. Supervision cost will be incurred to monitor and check idleness of the employer. The method is often unfair because lazy workers and hard workers are paid the same. Rates. 3.7.2 Output-based methods of remuneration. 3.7.2.1 Piece rate methods of remuneration. The amount earned by the employee is based on the number of units produced. Piece rates can be examined under three headings, namely: straight piece rate, differential piece rate, piece rate with guaranteed time rate. A straight piece rate. Under straight piece rates, the payment to the employee is computed thus: No of units produced X rate per unit. The worker receives a fixed rate for each unit produced which does not depend on the time taken to produce it. Earnings therefore depend on the volume of the worker's output. Illustration 3-2. Assume that number of units of Ankara shoes produced in butterfly concept is 2000 units. Rate per unit is N50,000. What is the gross wages to be paid based on straight piece rate? Remuneration. Suggested solution 3-2. Gross wage equals 2000 units x N50,000 equals N100,000.00. 3.7.2.2 Differential piece rate. Illustration 3-3. Normal rate per hour paid to a staff of butterfly concept is N2,000 and the standard time allowed is 20 units per hour. Assuming Biodun completes 80 units and Shina 50 units in 7 hours. Calculate the earnings of each employee. Biodun Shina 80-50. Rate per hour is N2,000. Units per hour is 20 units. Rate per unit, 100. Gross wage N8,000 N5,000 N100 x 80, N100 x 50. The remuneration is in direct proportion to the units produced by each employee. If time rates were used, both employees would receive 7 hours x N2000 equals N14,000. Advantages of the piece rate. Effort is rewarded and in consequence, the employee is given the incentive to produce more. Because employees are self-motivated, less supervision is required. The employees benefits from a reduction in the overhead cost per unit of production. Disadvantages of the piece rate. There is a danger that quality will be sacrificed, and in such a situation the employer would spend more on inspection and quality control. Piece workers, after earning certain remuneration during the week, might be satisfied and reduce their pace, arrive late or absent themselves. A considerable degree of time is involved in setting standard times, and as these are subject to the agreement of trade union representation, further time is often spent in detail negotiation before piece rates are established. If an error is made and piece rates are set too high, it is difficult subsequently to reduce them. This could prove to be extremely costly. 3.7.2.3 Piece rate with guaranteed day rate. It is a system adopted to compensate employees on account of low production, leading to earnings under piece rate being below the normal day rate remuneration. If an employee's earnings according to the piece work are less than the normal day rate, he is paid the day rate instead of the piece rate. Illustration 3-4. Assume the rate per hour is N15,000 and the cost per unit is N16,000 while the units produced is 8,000 units. Calculate the piece rate with guaranteed day rate of remuneration. Assuming that 8,800 hours were used to produce the entire unit. Piece rate earnings equals units produced x rate per unit equals 8,000 units x N15,000 equals N120,000,000. Since the guarantee hourly rate, 8,800 hours x n15,000 equals n132,000,000, is higher than the piece rate, the employee is paid the hourly wage of n132,000,000. 3.7.3 Differential piece rate. Under this scheme, the piece work rate changes at different levels of efficiency or production. Illustration 3 to 5. N10,000 is paid per unit when production is below 7 units per hour. N15,000 is paid per unit when it is 7 to 10 units per hour. N20,000 is paid per unit when production is above 10 units per hour, etc. The objective of this is to provide a strong incentive to reach the maximum rate of production. 3.7.4 Premium bonus schemes. Bonus schemes are intended to reward employee for their efficiency in saving cost for the organization through the saving of time. These are therefore schemes for sharing extra profit with employees. Types of premium bonus schemes. 1. Halsey bonus scheme. 2. Halsey-Weir bonus scheme. 3. Rowan bonus scheme. Halsey scheme. According to this scheme, the time saved should be apportioned equally between the employee and employer. Bonus equals 1/2 x time saved x day rate. Note, time allowed, time taken equals time saved. Halsey-Weir scheme. Under this scheme, the proportion is 2:1 in favor of the employer. Thus the employee gets only 1/3 of time saved at the rate per hour. Bonus equals x time saved x day rate. Rowan scheme. Under this system, the bonus award to the employee is the proportion between time taken and time allowed of the time saved. Bonus equals x time saved x day rate. It therefore follows that if the employee saves more time, he gets a greater bonus. Illustration 3 to 6. Time allowed equals 12 HRS. Day rate equals N18,000. Time taken by A equals 6 HRS. Time taken by B equals 9 HRS. Required, calculate the bonus to be rewarded to both employees using the Rowan bonus scheme. Solution. Rowan bonus scheme. Employee A. Time allowed equals 12 HRS. Time taken equals 6 HRS. Time saved equals 6 HRS. Bonus equals x time saved x day rate. Equals x6x n18,000. Equals n54,000. Employee B. Time allowed equals 12 HRS. Time taken equals 9 HRS. Time saved equals 3 HRS. Bonus equals x time saved x day rate. Equals x3 x 18,000. Equals n40,500. 3.7.5 Overtime remuneration schemes. Overtime is the time spent beyond the normal working hours or days. Overtime wage rates are expressed as time plus a fraction or multiples of time, e.g. I time and 1/2, 2 time and 1/3, 3 double time and 4 time and 1/5, and so on. 3.8 Direct and indirect cost of labor. The direct labor cost is the labor cost incurred on employees who are engaged in directly transforming the raw materials into finished goods. It must be noted that it is only the basic wages paid to direct workers that constitute direct labor cost. Policy-related cost incurred on direct workers is not direct labor but rather indirect. Example of these policies-related costs includes workman compensation premium paid to insurance companies, Employer's Social Security Fund contribution. Bonuses paid to employees. Overtime premium paid to employees where the overtime is worked regularly as company policy, etc. Wages incurred on indirect workers is indirect wages. Illustration 3 to 7. ABC Farms employs on her farm 120 workers as direct labor and 15 workers as indirect labor. The farm remunerates its labor as follows. A. Direct labor is paid regularly on the basis of units of output at the rate of N12,250 per unit. B. Indirect labor is paid regularly on the basis of hours worked at the rate of N14,000 per hour. C. Overtime premium is paid to all factory workers on the hours worked at the following rates. IN 26,000 per hour for direct labor. 2 N 28,000 per hour for indirect labor. D. The employer and employee contribute 10% and 5% respectively of gross pay to the pension fund. E. Each worker contributes dues to the local workers' union at the following rates. IN 50,000 per direct labor per month. 2 N 80,000 per indirect labor per month. The union dues are deducted at source. F. The farm in addition operates a workmen's compensation insurance scheme with for all factory workers. The monthly premium is N7,500,000.00 approximately divisible between direct and indirect labor in the ratio of 4:1. GPAYE tax is approximately 8% of monthly gross income. During this month of June 2012, the farm produced 30,000 units of products during regular working time of 8 hours a day for 22 days a month. The farm worked overtime of 6 hours a day for 4 days during the month and produced 3,200 more units of products. You are required to determine I. The cost to ABC Farms of factory labor for the month of June 2012. Distinguishing between direct and indirect labor cost. 2. The total net wages paid to the workers for June 2012. ICAG November 1999 for Quetzales. Solution. Workings: direct workers, indirect workers. No of units produced in normal time. 30,000 unit. Overtime production 3,200 units. Total units produced 33,200 units. Hours worked regular time 120 x 176 HRS. Equals 21,120 HRS. 15 x 17 HRS. Equals 2,640 HRS. Overtime hours 24 hours x 120 equals 2,880 HRS. N12, 250/unit. 24 hours x 15 equals 360 HRS. N14,000/HRS. Overtime rate N26,000/HR. N28,000/HR. Overtime pay 2,880 HRS at N26,000. Equals N74,889,360 HRS at N2800. Equals N10,880,000. Overtime piece rate. Equals N23,400. Overtime premium 11,150 N14,000. I. Direct and indirect cost. Direct wages. Indirect wages. Total basis. Wages N000 N000 N000. Direct worker 3,320 units at 12,250 40,670 to 40,670. Indirect worker 3,000 HRS, 42,000 42,000. Basic wages 406,700 42,400 and 48,700. Overtime premium. Direct workers, 3,200 x 11,150, 35,680 to 35,680. Indirect workers, 360 HRS x 14,000, 5,040 to 5,040. Premium for workman compensation 7,500 to 7,500. Employer pension scheme 10% of basic wages. Direct worker 40,670 to 40,670. Indirect workers, 4,200 4,200. Total labor cost 406,700 235,000 and 9,500 and 41,790. Direct indirect. Payroll NN. Basic wages 406,742,000. Pension scheme 5%, 20,335, 2,700. 386,365 39,900. Other allowances. Overtimes premium 45,600 and 85,040. 422, 045 44, 940. Taxable pay, 33,763.6, 3,595.2. Local union. Net wage per employee. 4.0 Conclusion. Labor cost cannot be excluding when calculating the total cost incurred in production. It is an important element in production cost. 5.0 Summary. This chapter explained the definition of labor cost, explained labor as a factor of production, and further examined division of labor and productivity, its advantages and disadvantages. It also focused on recruitment and the various forms of recruitments. And these forms are centralized and decentralized recruitments. Other areas also covered are, what constitutes recruitment cost, the methods of labor timing and assessment, work study, computation of labor cost using the various methods of remuneration, distinguish between direct labor cost and indirect labor cost and group incentive scheme. 6.0 Tutor marked assignment. Explain in details time-based and output-based forms of remuneration. 7.0 References/further reading. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adeniji A.A., 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures. Limited, Lagos, Nigeria. Lucy, T., 1994. Management Accounting. 3rd edition. Great Britain. Unit 4, Accounting for Overheads. Contents. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Types and classification of overheads. 3.2 Overhead allocation and apportionment methods. 3.3 The concept of overhead absorption. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 0.0 Introduction. Expenses/overheads constitute the third element of cost after materials and labor. It is the aggregate of indirect materials, indirect labor, and indirect expenses. Examples includes cost of cleaning materials, cost of stationery, cost of consumable materials. Superman cost, bonus payable to employees, salaries of indirect workers and so on. 2.0 Objectives. After studying this chapter, you should be able to distinguish between direct and indirect expenses. Explain overhead cost analysis. Explain the treatment of under and over absorption of overhead. Classify overhead. Calculate overhead's absorption rates using 6 methods. Make accounting entries with respect to overhead. 3.0 Main content. 3.1 Types and classification of overheads. 1. Production overheads. 2. Administrative overheads. 3. Marketing, selling and distribution overheads. 4. Research and development overheads. 3.1.1 Production overheads. These are the indirect cost of manufacturing a cost unit, e.g. materials consumed in the factory. Indirect factory wages and other indirect expenses incurred in connection with production. 3.1.2 Administrative overhead. These are cost of formulating policy, directing and controlling operations not related directly to production, selling, distribution or research and development. 3.1.3 Marketing overhead, selling and distribution. Salaries and commission of salesmen, advertising, rent and insurance of warehouses, bad debt. Collection charges, cash discounts allowed, etc. 3.1.4 Research and development overheads. These are costs of seeking new ideas, materials, methods of production and improved products, and the development and design of such ideas so that they can be applied to formal production. 3.2 Overhead allocation and apportionment methods. 3.2.1 Overhead allocation. This is the assignment of overheads to cost centers directly without sharing. Overhead cost that is specifically incurred in respect of a particular cost center is wholly assigned to that cost center. This is referred to as overheads allocation. 3.2.2 Overhead apportionment. This is the sharing of overhead cost incurred in respect of a number of cost centers to the centers involved using a fair and equitable basis of apportionment. There are some overheads costs that are incurred for a number of cost centers and at times even for the whole organization, e.g. of bases of apportionment commonly used are space occupied by cost center, number of employees, values of plant, number of materials requisitioned, kilowatt of energy used, etc. Illustration 3:1. Adam Ltd makes wooden crates which are sold to brewers and soft drinks bottling companies. The production work involves 3 production departments: saving, assembly and finishing. There are 2 service departments, maintenance and materials handling. During the year December 31, 2013, 40,000 crates were made. Saving, assembly, finishing. Cost incurred. Materials used 800,000, 600,000, 100,000. Direct wages 300,000, 750,000, 250,000. Overheads 120,000, 80,000, 30,000. Materials handling wages N21,000. Maintenance wages totaled N45,000. Consumable stores totaled N15,000. Maintenance. The department's benefits from the service departments are as follows. Saving percent assembly percent finishing. Percent. Material. Handling percent. Maintenance 30-40-20-10. Material handling 50-20-30. Required. A. Prepare a statement showing the overheads allotted to each production department. B. Calculate the unit cost of a wooden crate. Overhead analysis sheet. Saving assembly finishing maintenance materials. Handling. Overhead 120,000 80,000 30,000 45,000 21,000. Consumables 15, 00. 120,000 80,000 30,000 60,000 21,000. Maintenance 18,000 24,000 12,000, 60,000, 6,000. Material handling 13,500 5,400 8,100, 27,000. 151,500 109,400 50,000 100 000. Saving assembly finishing total cost per unit. Material cost 800,000 600,000 100,000 1,500,000 37.5. Direct wages 300,000 150,000 250,000 700,000 17,5. Overhead 151,500 109,000 450,000 100 311,000 7,78. 1,251,500 859,400 400,000 100 2,511,000 62.78. Unit cost per crate equals N 62.78. 3.3 The concept of overhead absorption. This is the process of assigning overhead costs to products or services produced. Overheads are absorbed into products by first calculating the overhead absorption rate and then apply the calculated overhead absorption rate to determine the overhead absorbed by each cost unit. To determine the overhead cost per unit of any product or service, therefore, the following process is followed. 1. The organization is divided into a production cost center or a service cost centers. 2. Allocate the cost to the various cost centers. 3. Those overhead costs that are incurred for more than one cost center should be apportioned among the beneficiary cost centers. 4. Reapportion the overhead cost of the service cost centers to the production cost centers. Where the service cost centers provide reciprocal services, it means one service cost center serves another and receives service from that other. Illustration 3-2. In such a situation, the following methods are used for reapportionment. A. Elimination method. B. Continuous method. C. Simultaneous equation method. Brown Manufacturing Company has 4 production departments and 3 service departments. Indirect labor and other indirect costs for a typical month have been allocated as shown. Brown Manufacturing Company. Production Department Service Department. Grinding. N000. Blending. N000. Firing. N000. Polishing. N000. Personnel. N000. Admin. N000. Maintenance. N000. Indirect labor. 4,600 3,300 5,400 2,900 700 1800 800. Other indirect cost. 1,400 1,200 2,800 1,600 500 300 1200. The service department's costs are allocated as follows. grinding, blending, firing, polishing, admin, maintenance. Personnel, percent. 15, 25, 30, 25, 5. Administration, percent. 10, 30, 40, 15 to 5. Maintenance, percent. 15, 30, 45, 10. In the grinding and firing departments, an overhead rate per machine hour was used, whereas in the blending and polishing department, an overhead rate per direct labor hour is used. Machine hours are budgeted as 620 in the grinding department and 520 in the firing department. Direct labor hours are budgeted as 1050 in the blending department and 450 in the polishing department. Required. A. Determine the total overheads for each of the production cost centers. B. Calculate the overhead recovery rates for each of the production department. Suggested solution. Elimination method. In this method, once a service cost center's overheads have been reapportioned, that service cost center is eliminated from further apportionments. Production cost centers, service cost centers. Overheads basis grindin. G. Blendin. G. Firing polishin. G. Person. L. Administratio. N. Maintenance. CE. N000 N000 N00 0. N000 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 N000. Indirect labor allocate 46,000 33,054,00. 0. 2,900 700 1,800 800. Other indirect cost. Allocate 1,400 1,200 2,800 1,600 500 300 1,200. Total 6,004, 5,000 8,200 4,500 1,200 2,100 2,000. Reapportionment. Service cost. Personnel 15 hours 25 minutes and 30 seconds 180 300 360 240 1,200 60 60. Maintenance 15 hours 30 minutes and 40 seconds 309 618 824 103 to 206 2060. Administration 10 hours 30 minutes and 40 seconds. 15:5. 249 747 996 374, 2,366. Overheads. Production costs 6,738 6,165 10,385 217 000. Centers. Overhead analysis sheet, elimination method. Continuous method. Each of the service cost center overheads will be continuously reallocated until the amount to be reapportioned becomes insignificant. The reappointment is ignored. Again, using the above example. Overheads basis grinding, blending, firing, polishing, personnel, administration. Maintenance. N000 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 N000. Indirect labor allocation 4,600 3,300 5,400 2,900 700 1,800 800. Other indirect cost. Allocation 1,400 1,200 2,800 1,600 500 300 1,200. Total 6,000, 4,500, 8,200, 4,500, 1,200, 2,100, 2,000. Reapportionment of service cost. Personnel 15:25:30:2. 0:5:5. 180, 300, 360, 240, 1,200, 60, 60. Administration 15:30:40:5. 10. 309, 618, 324, 103 to 206, 2,060. Maintenance 10:30:40:1. 5:5. 237, 710, 947, 354, 2,366, 118. Administration 15:30:40:5. 10. 1835, 47, 6 to 12. Maintenance 10:30:40:1. 5:5. 1452, 12. Production cost. Center 6,754, 6,167, 10,383, 5,205, 000. Overhead analysis sheet using continuous allotment method. Simultaneous equation. Here, the total allotment of overheads to a particular service cost center is the overheads allocated directly to that cost center plus the amount of overhead allotted to it from other service cost centers. The method uses equation. The amount to be charged to each service cost center is considered an unknown variable and worked for using the concept of simultaneous equations. Using the above example, P equals total personnel department overheads. A equals total administrative department's overhead. M equals total maintenance department overheads. Now, P equals 1,200. A equals 2,100 plus 0.05 P plus 0.10 M. But we know P to be 1,200. Thus, A equals 2,100 plus 0.05, 1,200, plus 0.10 M. A equals 2,160 plus 0.10 M, 1. M equals 2,000 plus 0.05 P plus 0.05 A. Equals 2,000 plus 0.05, 1,200, plus 0.05, A. M equals 2,060 plus 0.05 A, 2. B rearrangement, equation, 2, will be M, 0.05 A equals 2,060. 0.05 A equals 2,060, M. A equals 2,060, M. 0.05 0.05. A equals 41,200 plus 20 M, 3. Deduct equation, 1, from, 3. A equals 41,200 plus 20 M. A equals 2,160 plus 0.10 M. 0 equals 43,360 plus 19.90 M. 19.90 M equals 43,360. M equals minus 43,360 equals 2,179. Minus 19.90. Substitute M equals 2,179 into 1. A equals 2,160 plus 0.10, 2,179, equals 2,378. Therefore, P equals 1200. M equals 2179. A equals 2378. The overhead analysis sheet will then look as follows. Overhead analysis sheet. Overheads basis grinding blending. G. Firing polishing personnel administration maintenance. N000 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 N000. Indirect. Labor. Alicati. On. 4,600 3,300 5,400 2,900 700 1,800 800. Other. Indirect. Cost. Allocatio. 1,400 1,200 2,800 1,600 500 300 1,200. Cost N. Total 6,000 4,500 8,200 4,500 1,200 2,100 2,000. Overhead. Reapportion. Ment. Personnel 15:25:3. 0:20:5:5. 180 300 360 240. 1,200, 60 Administration. 15:30:4. 0:5:10. 238 713 951 357, 2,378, 119. Maintenance. CE. 10:30:4. 0:15:5. 327 654 872 108 to 218, 2,179. Production. Cost center. Overheads. 6,754 6,167 9,523 5,205 000. At the end of all these stages, the total overheads cost for each production cost center would have been determined. The next stage then is to absorb the overheads to cost units using any of the methods of overheads absorption. 3.3.1 Overhead absorption methods. The charging of the apportioned cost center overhead to cost units is referred to as overhead absorption. There are many methods or bases of charging overhead costs to cost units. Some of them are total output, direct material cost, direct labor hours, and direct machine hours. Formulae. Total cost center overhead. Overhead absorption rate equals total units of base used. 3.3.1.1 Total output base. Total cost center overhead. Overhead per unit equals total units of produced. If the apportioned overhead to cost center P2Y was N50,000 and the total output for the period was 10,000 units. Calculate the overhead cost per unit for the cost center. N50,000 equals N5 per unit. Overhead per unit equals 10,000 units. 3.3.1.2 Direct material cost base. This method is used where there is a correlation between overhead costs and quantity of direct materials used. Total overhead cost. Overhead per direct material cost equals total direct material cost used. If the apportioned overhead cost was N50,000 and the total direct material cost used was N100,000, the overhead per direct material cost can be expressed as percentage. N50,100. Overhead per direct material cost equals X equals 50% or N 0.5. N 100,0001. 3.3.1.3 Direct labor hour base. The overhead rate per direct labor is calculated as total overhead cost. Overhead rate per direct labor hour equals total hours engaged. Illustration. If the total overhead cost for the period was N 50,000 and the total direct hours engaged was 25,000 hours, calculate the overhead rate per labor hour engaged. 50,000. Overhead rate per direct labor hour equals N2. 25,000. It follows from the calculation that if a job or product required 4,000 direct labor hours, it will be charged 4,000 x N2 equals N 8,000. 3.3.1.4 Machine hour base. Here, the factory overhead is absorbed by dividing the total factory by the total machine time. Illustration. If the total factory overhead for the period was N 50,000 and the total machine hours used was 40,000 hours, calculate the overhead rate per machine hour. N 50,000. Overhead rate per machine hour equals N 1.25. 40,000 HRS. If therefore a particular job or product required 8,000 machine hours to complete, the overhead absorption for the product or job will be 8,000 hours x N 1.25 equals N 10,000. Other methods are time basis, blanket rate, predetermined rate, etc. Illustration 3-4. XYZ Manufacturing Company absorbed overhead by means of direct labor. The company annual budget for production overhead is shown below. Production overhead N 450,000. Direct labor hours 900,000 hours. During the year, the actual production overhead and direct labor hours are: quarter production overhead incurred, direct labor hours worked 150,000 300,000, 180,000 240,000, 150,000 210,000, 120,000 300,000. You are required to calculate using predetermined direct labor hourly rate the under or over absorbed expenses. Suggested solution. Predetermined direct labor hourly rate equals budgeted overhead equals N 450,000. Budgeted direct labor hours 900,000 hours equals 50 kobo per labor hour. Actual overhead expenses and direct labor hours worked. Quarters production overhead direct labor hours 150,000 300,000, 180,000 240,000, 150,000 210,000, 120,000 300,000. Total 600,000 1,050,000 hours. Predetermined overhead equals 1,050,000 x 50 kobo equals N 525,000. Less, actual overhead equals N 600,000. Underabsorbed overhead N 75,000. 4.0 Conclusion. Overhead costs are all manufacturing costs that are related to the cost object but cannot be traced to that cost object in an economically feasible way. Overhead cost can also be referred to as indirect costs. 5.0 Summary. This chapter focused on the distinction between direct and indirect expenses. It also explained overhead cost analysis and the treatment of under and over absorption of overhead. 6.0 Tutor marked assignment. 1. Explain the 4 classification of overhead. 2. Describe overhead allocation and apportionment. 3. If the total factory overhead of Coscarus Motors for the period 2012 to 2013 was and 5,000,000 and the total machine hours used was 40,000 hours, calculate the overhead rate per machine hour. Reference: Okoye, A.E., 2011 Cost Accountancy, Management Operational Applications. Mindex. Publishing Co. Limited, Benin. Horngren, Th., Dater, S.M., Foster, G., Rajan, M. and Idner, C., 2009, Cost Accounting. New Jersey, Pearson Education. Lucy, T., 1990, Costing. 3rd edition. Great Britain. Unit 5, Job and Process Costing. Content: 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Job Costing. 3.1.1 Components of Job Costing. 3.1.2 Factory Job Costing. 3.2 Process Costing. 1.0 Introduction. Management accountants use 2 basic types of costing systems to assign costs to products or services, and they include job and process costing. These 2 types of costing systems are best considered as opposite ends of a continuum. In between, one type of system can blur into the other to some degree. In this unit we shall be considering the job and process costing in details. 2.0 Objectives. After studying this chapter, you should be able to explain the meaning of job costing, list and explain the components of job costing, know the meaning of process costing. 3.0 Main Content. 3.1 Job Costing. Job costing is the process of tracking the expenses incurred on a job against the revenue produced by that job. For example, building contractors, subcontractors, architects and consultants often use job costing, whereas a hardware store or convenience store would not use job costing. Job costing using accounting software enables you to track a number of factors and analyze the results to aid decision making. A job costing report helps you ensure that all costs involved in a job have been properly invoiced to the customer. An estimates versus actual report compares quoted costs to actual costs, and quoted revenues to actual revenues so that you can analyze any variances between your quote and the actual result. You can then use the results of your analysis to create more accurate quotes when you bid on future jobs. Using job costing will allow you to identify the most and least profitable areas of your business, so that you can focus on the profitable elements, and try to make the less profitable aspects of your business more efficient. It will help you to quote new jobs more accurately, and assist you in managing jobs in progress. 3.1.1 Components of Job Costing. There are numerous aspects to job costing, and you may use many, some or none of them. If you want to use job costing, you need to track the costs involved in the job, make sure all of the costs are invoiced to the customer, produce reports showing details of costs and revenues by job. The fundamental components of job costing are quotes, also known as estimates, bids, or proposals; fixed fee jobs; time and materials jobs; revenues; items; direct costs; standard costs. 3.1.2 Factory Job Costing. Factory job costing is a type of job costing used when an order is small, and the completion of such order does not extend beyond one financial year. In most cases, the job is carried out within the factory e.g. providing electricity supply, plumbing work, building maintenance, equipment installation, etc. The procedure for costing a factory job is to open a job card for the job and give the job a code number. All the direct cost elements are charged to the job to get the job. Production cost. Other administrative, selling and distribution overheads are then added to arrive at the total cost. From the quotation price, selling price, deduct the total cost to arrive at profit on the job or loss made on the job. 3.2 Process costing. This is defined as a method for determining the total unit cost of the output of a continuous production run, such as in food processing, petroleum, and textile industries, in which a product passes through several processes, or cost centers. It involves the following steps. The total cost per process is computed by estimating the number of products passing through each process in a given period. The unit cost per process is computed by dividing the total cost per process by the number of units passing through the process in the given period. The unit cost per process is charged to each unit as it passes through each process so that, at the end of the production cycle, each product will have received an appropriate charge for each process through which it has passed. Self-assessment exercise. Differentiate between job costing and process costing. Illustration 3I. Adebisi & Co. Ltd. is an engineering company. The organization has three main functional sections, namely, machining, rolling, and assembling. The overhead costs over the years were apportioned by means of blanket rate at N0.5 per direct labor hour of the three main functional departments. However, the overhead costs for the selling and distribution costs were calculated as 15% of the production costs. The company has just employed a new executive director who has introduced a new policy on overhead absorption starting from the second quarter of the year, which commences on April 1, 2011. The new policy on overhead is as follows. Production overhead. Matching, 10% of direct material cost. Rolling, and 0.50 per machine hour. Assembly, and 0.60 per direct labor hour. Selling and distribution overhead, 20% of production cost. The company has just secured a contract job PCM 119 and the following estimates have been made. NN. Direct materials. MAT. PZ9 600 units at N6 per unit 3600. MAT. PM6 units at N10 per unit 8000. MAT. PL8 900 units at N8 per unit 7200 18800. Direct labor wages. Machining, 370 hours at N8 per hour 2960. Rolling, 500 hours at N8 per hour 4000. Assembly, 480 hours at N12 per hour 5760 12720. The contract price quoted for the job was N40,000 and the job took 1000 machine hours to complete. You are required to prepare a job cost sheet for the job PCM 119. A. If it was started and completed in the first quarter of the year, and B. If it was started and completed in the second quarter of the year after the new overhead policy has been introduced. Suggested solution. Job cost sheet job. No. PCM 119. Name of client. Address. Date of commencement, January. Date of completion, March. Direct material cost. MAT. PZ9 600 units XN6 3600. MAT. PM6 800 units XN10 8,00. MAT. PL8 900 units XN8 7200 18800. Direct labor wages. Machining 370 hours at N8 per hour 2960. Rolling 500 hours at N8 per hour 4000. Assembly 480 hours at N12 per hour 5760 12720. 31,520. Add, production overhead. 0.50 per direct labor hour, 1,350 HRSX 0.50 675. Product cost. 32,195. Add, selling and distribution, overhead at 15%. Of production cost, and 32,195 x 15%. 4,829.25. Total cost 37,024.25. Quotation price 40,000.00. Profit 2,975.75. B. Job cost sheet job. No. PCM 119. Name of client. Address. Date of commencement, January. Date of completion, March. Direct material cost. MAT. PZ9 600 units XN6 3600. MAT. PM6 800 units XN10 8,00. MAT. PL8 900 units XN8 7200 18800. Direct labor wages. Machining 370 hours at N8 per hour 2960. Rolling 500 hours at N8 per hour 4000. Assembly 480 hours at N12 per hour 5760 12720. 31,520. Add, production overhead. Machining, 10% of N18,800 1880. Rolling, 1000 hours XN 0.5500. Assembling, 1350 HRSX N 0.6810. 3190. Product cost, 34,710. Add, selling and distribution, overhead at 15% of production cost, and 34,710 x 20%. 6,942. Total cost 41,652. Quotation price 40,000. Profit 1,652. Illustration 3-2. ABC uses job order costing. It applies overhead cost to jobs on the basis of direct labor hours. For the current year, the company estimates that it will work 20,000 direct labor hours and will incur N equals 650,000 of manufacturing overhead. The following transactions took place during the year. A. N equals 300,000 of raw materials were purchased on account. B. Raw materials were issued into production N equals 90,000 direct materials and N equals 40,000 indirect materials. C. Labor costs incurred, equals N equals 40,000 direct, equals N equals 130,000 indirect, sales commissions. Equals N equals 50,000, administrative salaries equals N equals 100,000. D. Utility costs for the factory were equals N equals 60,000. E. Depreciation recorded was equals N equals 300,000, 70% related to factory, 30% related to administrative offices. F. Manufacturing overhead was applied to production. Actual direct labor hours incurred were 22,000. G. Units costing equals N equals 300,000 were completed and transferred into the finished goods inventory. H. Goods with a cost of equals N equals 150,000 were sold on account for equals N equals 200,000. Required, calculate the under/over applied overhead for the year. Suggested solution NN. A. Raw materials 300,000. Accounts payable 300,000. B. Work in process 90,000. Manufacturing overhead 40,000. Raw materials 130,000. C. Work in process 40,000. Manufacturing overhead 130,000. Sales commission expense 50,000. Administrative salaries expense 100,000. Salaries and wage payable 320,000. D. Manufacturing overhead 60,000. Accounts payable 60,000. E. Manufacturing overhead 210,000. Depreciation expense 90,000. Accumulated depreciation 300,000. F. Work in process 715,000. Manufacturing overhead, 1, 715,000. G. Finished goods 300,000. Work in process 300,000. H. Accounts receivable 200,000. Sales 200,000. Cost of goods sold 150,000. Finished goods 150,000. I. Manufacturing overhead 275,000. Cost of goods sold 275,000. 1. Predetermined. Overhead rate equals N equals 650,000 equals N equals 32.50 per DLH. 20,000 DLH. Overhead applied equals N equals 32.50 x 22,000 DLH equals N equals 715,000. Manufacturing overhead. Actual applied. 40,000. 130,000 715,000. 60,000. 210,000. 275,000 over applied. 4.0 Conclusion. Assignment of cost to a product is a highly technical process that should be carried out with care and caution. The job and process costing methods serve as very good way of assigning cost. 5.0 Summary. This unit explained the meaning of job costing and listed the components of job costing. It also covered the fundamental components of job costing and the meaning of process costing. 6.0 Tutor marked assignment. Explain in details job and process costing giving relevant examples. 7.0 References/further reading. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adenergy AA, 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures. Limited, Lagos, Nigeria. Module 4 Costing, Budgetary Control and Break-Even Analysis. Unit 1 Elements of Marginal Costing, Standard Costing, and Budgetary Control. Unit 2 Control and Cost Reduction. Unit 3 Nature and Uses of Accounting Ratios. Unit 4 Elements of Break-Even Analysis. Unit 1, The Elements of Marginal Costing, Standard Costing and Budgetary Control. Contents. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Advantages of Marginal Costing. 3.2 Standard Costing and Budgetary Control. 3.3 Variance Analysis. 3.4 Standard Costing and Budgetary Control. 3.5 Differences between Standard Costing and Budgetary Control. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor Marked Assignment. 7.0 References/further reading. 1.0 Introduction. The Chartered Institute of Management Accountants, CIMA, defines marginal cost as the variable cost of one unit of a product or service, and marginal costing as a principle whereby marginal cost units are ascertained. Marginal costing is one of the costing techniques management relies upon when considering costs for the purpose of ascertaining profit figures. It is necessary to mention here that the concept of marginal costing is a bit controversial. Marginal costing from the economist point of view represents the amount by which aggregate cost is changed if the volume of output is increased or decreased by 1 unit. Accountants, on the other hand, view marginal costing as a measure of the variable cost attributable to a cost unit on the grounds that within a normal range of output volumes variable cost will change with volume. 2.0 Objectives. At the end of this unit, you should be able to define marginal costing, explain the meaning and objective of standard costing, describe the uses of standard costing, identify the limitations of standard costing, explain the types of standard costing, define variance analysis. 3.0 Main Content. 3.1 Advantages of Marginal Costing. Easy for non-accountants to understand and can be used with standard costing systems. Can be used in break-even analysis. Fixed costs are incurred over a period of time. Such costs are not therefore directly related to production and hence are not included in the valuation of stock. Profits calculations are more realistic because they are related to the time period during which they arise. Fixed costs are not carried forward from one accounting period to the next. Assists. When choices have to be made between alternatives, and contribution, selling price, variable costs, is a critical consideration. Pricing policy can be related to variable costs as fixed costs are deducted from total contribution. This can assist when making decisions regarding special orders. The unit cost is predetermined. Problems arising from a variable fixed cost per unit are eliminated. Apportionment of overhead is required. Overhead apportionment is frequently calculated on a subjective basis of the relationship between fixed costs and departmental activity. Under or over absorption of overhead is avoided. The procedures to deal with under or over absorption of overheads take place when the level of activity differs from the pre-planned level. Useful when a costing is required for a specific decision that management is considering. Illustration 3:1. From the following data relating to 3 firms, Prepare a statement to show how profit is calculated using marginal costing. Firm A, Firm B, Firm C. Selling price per unit N25, N10, N12. Variable cost per unit N15, N4, N8. Annual fixed cost N60,000, N20,000, N120,000. Normal production level, units, 20,000, 5,000, 60,000. Actual production level, units, 20,000, 5,000, 60,000. Sales, units, 18,500, 4,250, 7,500. Exercise 1, Solution. Firm ANN. Sales 462,500. Less cost of sales. Variable costs 300,000. Closing stock, note, 22,500, 277,500. Contribution 185,000. Fixed costs, 60,000. Profit 125,000. Note. Closing stock, units, times variable cost per unit equals 1,500 times N15 equals N22, 500. Firm BNNN. Sales 42,000. Less cost of sales. Variable costs 20,000. Closing stock, 3,200, 16,800. Contribution 25,200. Fixed costs, 20,000. Profit 5,200. Note. Closing stock, units, times variable cost per unit equals 800 times N4 equals N3, 200. Firm CNNN. Sales 690,000. Less cost of sales. Variable costs 480,000. Closing stock, note, 20,000, 460,000. Contribution 230,000. Fixed costs, 120,000. Profit 110,000. Note. Closing stock, units, times variable cost per unit equals 2,500 times N8 equals N20, 000. Self-assessment exercise. Explain in detail the concept of marginal costing. 3.2 Standard costing and budgetary control. Planning and control are few of the functions of top management. Planning involves determination of objectives of a business, and it also refers to the manner in which these objectives are to be achieved. Thus, it refers to both problem solving, identification of alternatives, and decision-making, selection from alternatives. Plans can be of value only if they are achieved. The control function comes into play to measure the extent to which the plans are achieved, so that in case the actual results do not fully conform to the plans, efforts can be made to correct adverse tendencies. Control implies a system which provides for the establishment of a plan, operation of the plan, automatic feedback from the system, and automatic regulatory action, so that any deviation is corrected. Standard costing can be of immense use to the management in achieving the two aforesaid important spheres of functions. In the planning stage, standard costing can assist the managers with much of the necessary data. At the control stage, it can be used to find the extent and place where such inefficiencies exists, and also to suggest ways for combating them by bringing them to the attention of those who have authority to control them. 3.2.1 Definition of standard costing. Standard costing is a technique of costing consisting of rules and procedure to ascertain the Standard cost of products or services which are compared with the actual results to check the variations either for the purpose of a control measure or to revise it. Standard costing is defined by the ICWA, London, as the preparation and use of standard costs, their comparison with actual costs and the analysis of variances to their causes and points of incidence. The Institute of Chartered Accountants of Nigeria, ICAN, defines standard costing as a useful control technique based on the feedback control concept, which ensures the determination of standard costs of products or services and compares them with the actual results and costs, with the difference being referred to as a variance. This difference can be further explained by a process called variance analysis. Standard cost is defined as a predetermined cost which is calculated from management's standards of efficient operation and the relevant necessary expenditure. It may be used as a basis for price fixing and for cost control through variance analysis. According to CIMA, it can also be defined as the planned unit cost of the products, components, or services produced in a period. The main uses of standard costs are in performance measurement, control, stock valuation, and in the establishment of selling prices. 3.2.2 Objectives of standard costing. Some of the objectives of adopting standard costing are to encourage management and employees, since it ensures that they have to plan ahead. To provide a guidance on possible ways for assessing performance and efficiency. To control costs by establishing standards and analyzing variance. The standard costs facilitate stock and work in progress valuation, profit planning, and decision making. 3.2.3 Uses of standard costs. Standard costs is an effective way for planning and controlling costs. Pricing decisions and decisions involving submission of quotations, answering tenders, etc., are also facilitated by the use of standard costs. Identification and measurement of variances from standards has been made possible with the use of standard cost, with a view to improve performance or to correct loose standards, if any. Facilitates management by exception. 3.2.4 Limitations of standard costing. Establishment of unattainable standards. The problem of identifying the specific need on consumers. Persistent rise in general price level. Problem associated with the accurate estimation of normal loss in the course of production. Frequent changes in the level of technology. Negative attitude of operating manager towards the established standards. The technique may be very expensive to operate, especially where technicalities are involved and setup time is elongated. 3.2.5 Types of standard. Performance standard setting are a function of four basic standards. A. Ideal standard. These represents the level of performance attainable when prices for material and labor are most favorable, when the highest output is achieved with the best equipment and layout, and when the maximum efficiency in utilization of resources results in maximum output with minimum cost. These are based on perfect operating conditions whereby there are no wastages, inefficiencies, idle time, breakdown of machines, etc. Staff may be of the opinion that the standards are difficult to achieve and may therefore put less efforts in achieving them. So, ideal standards are not necessarily encouraging. B. Attainable/expected standard, also referred to as practical standard, represents an established standard specifically premised on what is considered practicable within the organization. This is a function of normal operating circumstances, ensuring that some allowances are available for losses, wastages, inadequacies, etc. This standard makes for a challenging situation for employees in as much as psychological awareness is created. C. Current standard. This standard reflects the management's anticipation of what actual costs will be for the current period. These are the costs which the business will incur if the anticipated prices are paid for the goods and services and the usage corresponds to that believed to be necessary to produce the planned output. But this standard does not seem to bring about a higher current level of performance. D. Basic standard. This will represent an old established standard designed principally to satisfy a given objective. Basic standards are not subject to frequent alteration, therefore outdated in nature as a result of changes in technology, laws, norms, etc. They can only be used to express changes in the level of efficiency or performance over a period of time as well as the trend of prices from period to period. Self-assessment exercise. 1. What is standard costing? 2. Explain the different types of standards. 3.3 Variance analysis. The major application of standard costing is for controls, through variance analysis and reporting. A variance is simply the difference between planned or budgeted costs and actual costs, and similarly in respect of revenues, while variance analysis is the analysis of variances in a standard costing system in constituent parts. It is the analysis and comparison of the factors which have caused the difference between predetermined standards and actual results with a view to eliminating inefficiencies. 3.3.1 Types of variances. The basic variances can be categorized under 4 major headings. A. Sales volume variance. B. Sales price variance. C. Variable cost variances, which is direct material, direct labor, and variable overheads, which can also be subdivided into spending and efficiency variances. D. Fixed overhead cost variances, that is, expenditure and volume variances, which can be further categorized into efficiency and capacity variances, which can also be subdivided into capacity usage and fixed overhead idle time variance. 3.3.2 Possible causes of variance. The following are the more common factors attributed to variances in manufacturing concerns. A. Material price, buying materials at a price different from the specified buying price. Inefficiency of the purchasing department in seeking the most advantageous sources of supply, changes in market condition causing general price increase, purchase of inferior or superior quality materials. B. Material usage, using more or less quantities of material than those specified to achieve the actual production, careless handling of materials by the production workers. Purchase of inferior quality materials. C. Labor rate, paying labor at a rate different from the agreed rate, assignment of work to higher grade labor, negotiated increase in wage rates not reflected in the standard wage rate. D. Labor efficiency, the workforce spending more or less time than allowed for the actual production, waste of time due to use of inferior quality materials, use of different grades of labor from that specified. E. Overhead, since the recovery rates are always based on budgeted figures, any deviation from budget will give rise to a variance. Therefore, overhead variance will be caused by the following factors: actual expenditure being different from the budgeted expenditure, actual production being different from the budgeted production. Illustration. DD Project produces and sells Vuvi drinks for children. The standard direct cost per crate is as follows. Materials: 100 liters concentrated juice at N2 per liter. 200 liters of carbonated water at N2.50 per liter. 10 labor hours at N9.00 per hour. The budgeted monthly production and sales is 500 crates and the selling price is N1,000 per crate. The following details relate to October 2003, when 510 crates of Veuve drinks were produced and sold. N. Sales 506,500. Materials used: concentrated coconut juice 51,600 liters 102,500. Carbonated water 101,500 258,800. Labor: 5,000 hours. Cost 45,750. Required: A. Compute the price and usage variance for each material. B. Calculate the wage rate and efficiency variances. C. Comment briefly upon the information revealed by each of the variances you have computed. Solution: A. I. Material price variance. STD price: actual price, x actual quantity concentrated carbonated coconut juice water. NN. Actual quantity x standard price, 51,600 x 103,200. 253,750, 101,500 x 2.50. Actual quantity x actual price 102,500 258,800. Variance 700 F5,050 A. Total material price variance 4,350 A. 2. Material usage variance. Standard quantity, actual quantity, x STD price. Containers, 510 x 100 x 102,000. 255,000, 510 x 200 x 2.50. Actual quantity x STD price, 51,600 x 103,200. 253,750, 101,500 x 2.50. Variance 1,200 A 1,250 F. Total material usage variance 50 F. B. I. Wage rate variance. STD rate, actual rate, x actual hours. STD rate x actual hours, N9x 5,000, 45,000. Actual rate x actual hours 45,750. Variance 750. 2. Efficiency variance. STD hours, actual hours, x STD rate. STD rate x STD hours for 510 containers 45,900. N9x 5,100, 45,000. STD rate x actual hours N9x 5,900 F. C. Comments. Material price variance. Concentrated coconut juice gave a favorable variance while carbonated water gave adverse. It could be due to any of the following. I. Unexpected change in the price of the materials. 2. Faulty determination of standard price. Material usage variance. Concentrated coconut juice gave an adverse variance while carbonated water gave an almost compensating figure of favorable variance. Considered in total, the net effect could be misleading, but considered separately, we may be able to discover the following. I. The use of employees with varying levels of experience in production leading to either minimum or excess wastages. 2. The use of either better or inferior quality material. 3. The condition of the machinery used in production would have an effect on materials consumption and waste generation. Wage rate variance. The adverse variance recorded here may be due to paying higher rates than anticipated, or the use of skilled labor where unskilled labor was earlier planned. 4. Labor efficiency variance. This gave a favorable variance. If skilled labor was used instead of unskilled, the favorable efficiency variance could be the result. 3.4 Standard costing and budgetary control. Budgets are financial and/or quantitative statements, prepared and approved prior to a defined period of time, of the policy to be pursued during that period for the purpose of attaining a given objective. They include estimates of income, costs, and employment of capital. Out of these, only budgeted costs are strictly comparable to standard costs. Both budgeted and standard costs are set up to exercise costs control and to judge performance by setting up targets. Both of them provide benchmarks against which the actual performance and costs are compared. Variances are calculated and the reasons for the variances ascertained. 3.5 Differences between standard costing and budgetary control. Budgets are almost always stated in financial terms while standards need not be monetary. Example of non-financial standards include material usage standards, standard hours, etc. Budgets are usually focused on cost centers, that is, they aggregate the costs of cost centers, while standards are usually set for the various activities. A budgetary control system can operate without standard costs. The two systems are not interdependent, i.e., they can exist independently. 4.0 Conclusion. Standard costing involves comparing actual costs with predetermined costs. It is similar to budgets because they both provide benchmarks to measure performance. But budgets are usually financial in nature while standards may not necessarily be financial. 5.0 Summary. In this chapter, we discussed the concept of marginal costing and standard costing. It also focused on the objectives, uses, limitations and types of standard costing. It concluded by differentiating between standard costing and budgetary control. 6.0 Tutor marked assignment. I mention the limitations of standard costing. 2. List the types of standard costing. 3. What are the possible causes of variance in costing? 7.0 References/further reading. Adeniji A.A. 2012. An Insight into Management Accounting, 6th edition, El Toda. Ventures Limited, Mushin, Lagos. Institute of Chartered Accountants of Nigeria, 2006, Management Accounting. Okoye, A.E., 2011. Cost Accountancy, Management Operational Operations. 2nd edition. Mindex Publishing Company Limited. Benin City, Nigeria. Icon Study Pack, Costing and Quantitative Techniques, V/I Publishers, 2009. Unit 2, Cost Control and Cost Reduction. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Tools for Cost Control. 3.2 Cost Reduction. 3.2.1 Scope of Cost Reduction. 3.2.2 Tools for Cost Reduction. 3.3 Similarities and differences between cost control and cost reduction. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. Cost control is the regulation of cost of operating a business and is concerned with keeping costs within acceptable limits. This limit will either be specified as a standard cost, target cost limit, or in the form of an operational plan or budget. When actual costs differ from planned costs by an excessive amount, cost control measures become necessary. Cost control is a good way to exercise good bookkeeping and also avoid wasteful use of an organization's valuable scarce resources. 2.0 Objectives. After studying this unit, you should be able to explain the meaning of cost control, identify the tools for cost control, explain the term cost reduction, explain the tools for cost reduction, define variance analysis and state the objectives of variance analysis. 3.0 Main content. 3.1 Tools for cost control. Cost control involves instilling measures that continually monitor costs and indicate needs for control action for effective management of resources. The process of cost control usually follows this sequence. A. Setting the acceptable or expected level of cost for various activities. B. Measuring actual cost of activities as they unfold. C. Comparing actual costs with those predetermined, and D. Taking corrective action where necessary. The setting of predetermined level of costs to be compared with actual cost gives room for two basic tools to be employed in cost control: standard costing, budgetary control. These two perform complementary rather than conflicting functions, thus they are usually combined and used in organizations as effective cost control measures. Cost control ought to lead to excessive reduction in cost accumulation and spending. 3.2 Cost reduction. This is a planned positive action aimed at reducing costs of products or services without adversely affecting their quality or usability. While cost control is about keeping actual costs within acceptable limits, cost reduction maintains that even those predetermined amount might be too high. Cost reduction is usually focused on the expected costs with a view to reducing the eventual cost of operations. Cost reduction begins with the assumption that current cost levels or planned cost levels are too high, even though cost control might be good. The major difficulties with cost reduction: resistance by employees to pressure to reduce costs, usually because it has not been properly understood by them. Application might be limited to a small area of the business only to discover that it reappears as an extra cost to another cost center. Cost reduction campaigns are often introduced as a rushed, disparate measure instead of a carefully organized, well thought out exercise. 3.2.1 The scope of cost reduction. The scope of cost reduction embraces activities of the entire company, from production to marketing and at all levels within the organization, from the operative to top levels. Costs reduction efforts may include the following: A. Material costs, which may include quantity discounts or cash discounts for early payment to suppliers negotiated at favorable discount rates. Inventory control policy improvement, value analysis, reduction in material wastage. B. Labor costs, which includes replacing labor-intensive jobs with automated machines. Related jobs, having a production efficiency rewarding plan with the employees. C. Finance costs, where bank overdraft expenses may be better reduced by effective cash monitoring efforts. D. Rationalization measures, as a company expands in activities, there may be duplication of efforts in the different facets of its operations. However, this duplication can be removed. by ensuring that resources are concentrated in the firm, and this is referred to rationalization efforts, which is aimed at cost reduction that brings about efficiency at the workplace. Self-assessment exercise. State the scope of cost reduction. 3.2.2 Tools for cost reduction. A. Value analysis. This is a systematic interdisciplinary examination of the factors affecting the cost of a product or service, with the aim of devising a means of achieving the desired purpose most economically, at the required standard of quality and reliability. Objectives of value analysis. Cost elimination or cost prevention. Cost reduction. Improving product quality and so selling greater quantities at the same price as before. Improving product quality, and so being able to increase sales price. Features of value analysis. It encourages innovation and a more radical outlook for ways of reducing costs. It recognizes the various types of value which a product or service provides, analyses this value, and then seeks for ways of improving or maintaining aspects of this value but at a lower cost. Aspects of value analysis. Cost value. The objective of the exercise is to reduce costs. This affects all aspects of cost, from production to distribution. Exchange value. This is the market value of a product or service. Usage value. This refers to the function and performance of the product, that is, what purpose was it meant to serve. Esteem value. This refers to the prestige the customer attaches to the product. Other tools for cost reduction include total quality management, just-in-time processes and work study. B. Total quality management, TQM. This is a term used to describe a management philosophy based on the continuous improvement of quality. It is an idea focused on the reduction or eventual elimination of the cost of reworking. C. Just-in-time, JIT, processes. Its aim is to reduce inventory levels and its attendant costs. JIT requires that products or materials are not acquired in anticipation of sales or use. Rather, the materials and products are acquired only when needed. D. Target costing. Target costing is actually working backwards to find out the target cost which a firm would be able to achieve. In this technique, the first stage is to determine the target price, which the product will fetch in the market. In the second stage, target profit margin is determined, and in the third and final stage the target profit margin is deducted from the target selling price to arrive at the target cost. E. Work study. Work study may be viewed as a cost reduction technique. This is a critical analysis of the method of work carried out by examining the various stages of a production line with the aim of finding the most efficient means of production and ensuring that only that means is employed during production. Work study seeks out efficient operations which will ultimately reduce cost of operations. 3.3 Similarities and differences between cost control and cost reduction. Cost control and cost reduction are similar as they both I ensure the efficient utilization of resources. 2. Involve the presetting of a target after an initial cost analysis. The differences include the following. I. Cost control is static with the basic objectives of containing cost within preset target, while cost reduction aims to reduce costs from some predetermined target without reducing the benefits derived from the product made or services rendered. 2. Cost control is an ongoing process while cost reduction is on ad hoc basis. 3. They both have quite distinct objectives and different techniques are used to achieve their goals. 4.0 Conclusion. Costing is an important activity in an organization. Techniques such as cost control and cost reduction can therefore not be overemphasized. This is because one of the major objectives of an organization is cost minimization. 5.0 Summary. This chapter focused on cost control and the various tools that can be utilized for cost control. It further explained the meaning of cost reduction and the tools for cost reduction. 6.0 Tutor marked assignment. A. The process of regulating costs of operation of a business and keeping the expenditure within acceptable limits is underscore 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 underscore. B. A planned positive approach to reducing expenditure because of its excessiveness is underscore 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 underscore. C. State three main objectives of method study. 7.0 References/further reading. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Lucy, T. 1990. Costing. 3rd edition. Great Britain. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adeniji AA, 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures Limited, Lagos, Nigeria. Institute of Chartered Accountants of Nigeria, 2006, Management Accounting. Lucy, T. 1994. Management Accounting. 3rd edition. Great Britain. Unit 3, Nature and Uses of Accounting Ratios. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main Content. 3.1 Uses of Accounting Ratios. 3.2 Classification/types of ratios. 3.2.1 Solvency ratio. 3.2.2 Profitability ratio. 3.2.3 Activity ratio. 3.2.4 Investment ratio. 4.0 Conclusion. 5.0 Summary. 6.0 Tutor marked assignment. 7.0 References/further reading. 1.0 Introduction. A financial statement is an official document of the firm, which explores the entire financial information of the firm. The main aim of the financial statement is to provide information and understanding of the financial performance and position of a firm so as to ensure that users of financial statements make informed decisions. Hence, preparation of the financial statement is as important as the financial decisions. Financial statements prepared by companies are meant to provide its users with reliable information about the company's performance and financial position. Due to the fact that financial statements provide information that is not specific, that is, financial statements are prepared for all classes of users, it is important that such statement be subjected to further analysis. Ratio analysis is a useful tool for financial statement analysis. Ratio is one number expressed in terms of another number to show the relationship between them. Ratio is used as an index for evaluating the financial performance of the business concern. Adams, 2013, stated that what happened in the past should be a guide to the future. Previous years' published statements are analyzed and evaluated in order to form an opinion on the trend. It was further explained that to Interpret means to put the meaning of a statement into simple terms for the benefit of users. 2.0 Objectives. After studying this unit, you should be able to define ratio analysis, explain the uses of ratios, identify the limitations of accounting ratios, explain the classification and types of ratios, compute the various ratios. 3.0 Main content. 3.1 Uses of accounting ratios. Accounting ratio serves as a means of summarizing financial information. Accounting ratio is simply one figure divided by another. Therefore, there is almost an infinite range of ratios that can be calculated. The calculation of ratios simplifies the comparison of different companies. Statement because certain variables, such as size, are compensated for. Therefore, it can be possible to compare the profitability of two competing companies if the profit figures were expressed as a percentage of capital employed or divided by total fixed assets. 3.2 Classification/types of ratios. Ratio analysis focuses on different issues as they relate to the measurement of a company's performance, which include the financial results of the company as they have to do with the generation of revenue, the company's ability to meet up with her obligations in both the long and short run, the evaluation of the company's results relative to the benefits to be derived by the owners of the business, existing or potential. In computing ratio analysis, one has to know the appropriate ratio to be employed in a given situation. When this has been determined, calculating the specific ratio rests more on knowing the formula. Financial or accounting ratios can be classified into solvency ratios, profitability ratios, activity ratios, investment ratios. 3.2.1 Solvency ratio. These ratios can be categorized into two: short-term solvency or liquidity ratio and long-term solvency or leverage ratio. A. Liquidity or short-term solvency ratios are used to determine the ability of the company to meet its current obligations or liabilities. Illiquidity will result to loss of goodwill, poor credit ratings, and undue legal tussles, which may eventually lead to the winding up of a company. Excess liquidity could also lead to underutilization of assets. The liquid ratio can be classified as current ratio, quick or acid test ratio, cash ratio, interval measure, net working capital ratio. The current ratio is a measure of the relationship between the current assets and current liabilities. A ratio greater than 1 shows that the company has more of current assets than current liabilities. The ratio ideally is expected to be 2:1. Current ratio equals current assets/current liabilities. The quick or acid test ratio shows the relationship between liquid assets and current liabilities. The stock and prepayment items are not always included in the current assets because stock items are not usually the same in different companies, while prepayments may not be easily recoverable. The quick ratio is calculated as current asset stock prepayments. Current liabilities. A general quick ratio of 1:1 is considered reasonable for financial purposes. Cash ratio is used to determine the degree of responsiveness of cash and cash equivalent to take care of current liabilities and ascertain the ability of the company to hold enough cash and cash equivalents per time. It can be expressed as cash plus marketable securities/trade investment. Current liabilities. The interval measure ratio is that which is used to evaluate the company's ability to take care of its constant cash expenditures, that is, it is used to measure the relationship of liquid assets to average daily operating cash overflows. It is also used to determine the number of days that will be sufficient for liquid asset to finance operation without having any cash intake. Interval measure equals current asset, inventory/stocks. Average daily operating expenditures. Net working capital ratio is that which measures the difference between the current assets and current liabilities, which is an expression of the company's potential funds reserved. It can therefore be measured as the relationship with net assets. Net working capital equals net current assets. Net assets, capital employed. B. Leverage or long-term solvency ratios are used to ascertain the long-term financial performance of a company, hence, the usage of the terms financial leverage or capital structure. This ratio measure the company's competence to engage debts to the shareholders' benefits. The ratios that can be computed under leverage ratio include gearing ratio. This ratio measures the extent to which fixed interest liabilities relate to the equity. A company may be lowly geared when the ratio is less than 50% or highly geared when it is higher than 50%. The more highly geared a firm is, the greater the risk and the little earnings that would be available for distribution. Long-term debt. Debt plus equity. Dividend cover. This indicates the number of times fixed dividend is covered by profit. Net profit after tax. Dividend. Debt-equity ratio. This ratio indicates the financial plan of the entity and shows if the entity is financed more by debt or by equity. Debt capital. Equity. Proprietary ratio. This ratio indicates the extent or degree to which unsecured credit are protected against losses in the event of liquidation. Shareholders' fund. Tangible assets. Interest cover. This ratio indicates how many times operating profit will be able to cover interest paid. Operating profit. Fixed interest. Self-assessment exercise. Explain in detail solvency ratio. 3.2.2 Profitability ratios. Profitability ratio helps to measure the profitability position of the business concern. It shows the return that the company earn on its investment. Some of the major profitability ratios are given below. Net profit margin. This indicates the net margin due to the business after deducting expenses from revenue. The higher the percentage, the more efficient the entity will deem to be controlling its revenue expenses. Net profit before tax times 100. Sales. Gross profit margin. This ratio indicates the gross margin achieved by the enterprise on its sales of goods. In a nutshell, it is the percentage of sales earned as operating profit. Gross profit times 100. Sales. Operating profit margin. This ratio indicates what percentage of sales is generated as operating profit. It measures the relative efficiency of the entity in managing operational expenses before interest charges. Operating profit before interest and tax times 100. Sales. Assets turnover. This measures the efficiency of the firm in utilization of capital employed to generate income. Sales times 100. Capital employed. Return on capital employed. ROCE. This ratio indicates the percentage return generated by total funds employed to finance the operations of a company during an accounting year. The higher the percentage, the more profitable the enterprise will be deemed to be. In interpreting ROCE, the investors Minimum expected rate of return on similar investment should be taken into consideration. Operating profit times 100. Capital employed. Capital employed can be defined as share capital only, share capital plus reserve, equity only, share capital plus reserve plus long-term liabilities. 3.2.3 Activity ratios. It is also called turnover ratio. It is used by companies to assess the degree of effectiveness achieved with the utilization of their assets. They also show the rate at which assets are turned over into sales. They are therefore used to measure the relationship between sales and assets. The ratios include stock turnover ratio, cost of sales, average inventory, debtors turnover ratio, credit sales, average debtors, creditors turnover ratio, credit purchase, average credit, working capital turnover ratio, sales, net working capital. 3.2.4 Investment ratios. These ratios assess the return attributable to each share. It is an offshoot of the profitability ratio, and it is used to determine the ability of the company as it relates to the consistency in sustaining investment potentials and stability. They include earnings per share. It indicates the amount of the net profit after tax attributable to each ordinary share issued, and ranking for dividend during the period. Profit after tax. No of ordinary share in issue. Dividend per share. It indicates the dividend and retention policy of the company when used in conjunction with earnings per share. Total dividend. No of ordinary share in issue. Earnings yield. This indicates potential return on investment by shareholders, owners. Earnings per share times 100. Market value per ordinary share. Dividend yield. Indicates actual return on investment. Dividend per share times 100. Market price per share. Price-earnings ratio. This ratio indicates how many times earnings must be generated to cover the amount invested on a share. Market price per share. Earnings per share. 4.0 Conclusion. Ratio analysis uses financial reports and data and explains key relationships, for example, gross profit to sales, in order to assess financial performance. Its importance becomes greatly enhanced when trends are determined, comparative ratios are available and interrelated ratios are made available. 5.0 Summary. This unit discussed ratio analysis with regards to solvency ratio, profitability ratio, activity ratio, and investment ratio. 6.0 Tutor marked assignment. I define the term ratio analysis. 2. State 2 long-term solvency ratio. 3. Explain in details investment ratio. 7.0 References. Okoye, A.E., 2011. Cost Accountancy, Management Operational Application, Mindex. Publishing Co. Ltd., Benin City. Accounting Technicians Scheme West Africa, 2009, Cost Accounting. ABWA Publishers. Adnaji AA, 2012. An Insight into Management Accounting, 6th ed. El Tota Ventures Limited, Lagos, Nigeria. Lucy, T., 1994. Management Accounting. 3rd edition. Great Britain. Institute of Chartered Accountants of Nigeria, 2006, Management Accounting. Unit 4, Elements of Break-Even Analysis. Content. 1.0 Introduction. 2.0 Objectives. 3.0 Main content. 3.1 Break-even point formula. 3.2 The break-even chart. 3.2.1 Fixed cost. 3.2.2 Variable cost. 3.2.3 Semi-variable cost. 3.3 Ways to lower break-even point. 3.4 Advantages of break-even analysis. 3.5 Disadvantages of break-even analysis. 1.0 Introduction. One of the most common tools used in evaluating the economic feasibility of a new enterprise or product is the break-even analysis. The break-even point is the point at which revenue is exactly equal to costs. At this point, no profit is made and no losses are incurred. The break-even point can be expressed in terms of unit sales or Naira sales. That is, the break-even units indicate the level of sales that are required to cover costs. Sales above that number result in profit and sales below that number result in a loss. The break-even sales indicate the gross sales required to break even. It is important to realize that a company will not necessarily produce a product just because it is expected to break even. Many times, a certain level of profitability or return on investment is desired. If this objective cannot be reached, which may mean selling a substantial number of units above break-even, the product may not be produced. However, the break-even is an excellent tool to help quantify the level of production needed for a new business or a new product. 2.0 Objectives. After studying this unit, you should be able to define break-even analysis, interpret the break-even chart, explain the advantages and disadvantages of break-even analysis, compute the break-even point. 3.0 Main content. 3.1 Break-even point formula, to determine the units required to break even. Units required to break even equals fixed cost, unit selling price, variable cost per unit, or fixed cost, contribution per unit. Revenue required to break even equals fixed cost. Contribution margin ratio, or equals fixed costs x sale price / unit. Contribution per unit. Contribution to sales ratio, equals contribution / unit x 100. Sale price per unit 1. Units required to reach target profit after tax, equals FC plus, target profit. 1 Tax rate. Contribution per unit. Sales revenue required to reach target point, equals FCX, target profit x selling price / unit. Contribution per unit. 3.2 The break-even chart. In its simplest form, the break-even chart is a graphical representation of costs at various levels of activity shown on the same chart as the variation of income, or sales, revenue, with the same variation in activity. The point at which neither profit nor loss is made is known as the break-even point and is represented on the chart below by the intersection of the two lines. 3.2.1 Fixed costs. Fixed costs are those business costs that are not directly related to the level of production or output. In other words, even if the business has a zero output or high output, the level of fixed costs will remain broadly the same. In the long term, fixed costs can alter, perhaps as a result of investment in production capacity, e.g. adding a new factory unit, or through the growth in overheads required to support a larger, more complex business. Examples of fixed costs include rent and rates, depreciation, research and development, marketing costs, non-revenue related administration costs, etc. 3.2.2 Variable costs. Variable costs are those costs which vary directly with the level of output. Examples include raw materials, direct labor, fuel, and other revenue-related costs such as commission. 3.2.3 Semi-variable costs. Whilst the distinction between fixed and variable costs is a convenient way of categorizing business costs, in reality there are some costs which are fixed in nature but which increase when output reaches certain levels. These costs are referred to as semi-variable costs. 3.3 Ways to lower break-even point. There are 3 ways to lower your break-even volume, only 2 of them involve cost controls, which should always be the goal of an entity on an ongoing basis. 1. Lower direct costs, which will raise the gross margin. Be more diligent about purchasing material, controlling inventory, or increasing the productivity of your labor by more cost effective scheduling or adding more efficient technology. 2. Exercise cost controls on your fixed expense, and lower the necessary total expenses. Be careful when cutting expenses that you do so with an overall plan in mind. You can cut too deeply as well as too little and cause distress among workers, or you may pull back marketing efforts at the wrong time, which will give out the wrong signal. 3. Raise prices of goods and services. Most entrepreneurs are reluctant to raise prices because they think that overall business will fall off. More often than not, that doesn't happen unless you are in a very price-sensitive market, and if you are, you really have already become volume-driven. 3.4 Advantages of break-even analysis. The following are some of the advantages of break-even analysis. It is simple to conduct and understand. It shows profit and loss at different levels of output. It can cope with changing circumstances, e.g. the following changes in the business environment can be shown in a break-even chart. It measures profit and loss at different levels of production and sales. It can predict the effect of changes in price of sales. It can be used to analyze the relationship between fixed cost and variable cost. It is useful in predicting the effect of profitability of changes in cost and efficiency. 3.5 Disadvantages of break-even analysis. Below are some of the major disadvantages of break-even analysis. It assumes that all output is sold at the given price. This may well be untrue. Although it can cope with changes in circumstances, these factors change regularly, reducing its usefulness as a forecasting tool. The model assumes that costs increase constantly and do not benefit from economies of scale. If the firm obtains purchasing economies of scale, then its total cost line will no longer be straight. Break-even analysis is only as good as the data upon which it is based. Poor quality data will lead to inaccurate conclusions being drawn. It assumes that selling prices are constant at all levels of output. It assumes production and sales are the same. Break-even charts may be time-consuming to prepare. It can only apply to a single product or single mix of products. But, despite these difficulties, break-even analysis is universally applicable. Attempts to apply it will bring out deficiencies in accounting and cost-tracking practices and will indirectly improve the management of the business. Illustration 3:1. ABC Manufacturing Company produces exercise books for primary schools and the data for the production is given below. Variable cost equals N15 per unit. Fixed cost equals N100,000. Selling price equals N25. You are required to calculate A. Number of units of the exercise book that will be produced in order to break even. B. Sales revenue to be attained to break even. C. Contribution to sales ratio. D. Number of units to be sold to make a profit of N50,000. E. Sales revenue required to make profit of N50,000. Suggested solution. A. Units required to break even equals or equals 10,000 units. B. Sales revenue required to break even. C. Contribution to sales ratio equals 40%. D. Units required to reach target profit equals 15,000 units. E. Sales revenue required to reach target profit. 4.0 Conclusion. Break-even analysis determines both the minimum amount of sales required to avoid a loss or to break even at the end of the fiscal year and permits you to adjust sales estimates accordingly. Break-even analysis can be very helpful in the evaluation of a new venture. In most instances, success takes time. Many new enterprises and products actually operate at a loss, at a point below break-even, in the early stages of development. Knowing the price or volume necessary to break even is critical to evaluating the time frame in which losses are permissible. The break even is also an excellent benchmark by which a company's short-term goals can be measured/tracked. Break-even analysis mandates that costs be analyzed. It also keeps a focus on the connection between production and marketing. 5.0 Summary. In this unit we discuss the concept of break-even analysis by considering the break-even point formula and the break-even chart. We also considered the ways to lower the break-even point. 6.0 Tutor marked assignment. Explain the break-even point in details by making reference to fixed cost, variable cost, and semi-variable cost. 7.0 References/further reading. Hodgetts, R. and Donald Kuritko, 1986, Break-Even Analysis Management, 2nd edition, Assistant Extension Specialist Agricultural Development Center. Fred, C. H. and Peter, G.G., 2009. Break-Even Analysis, a Decision-Making Tool. U.S. Small Business Administration, Office of Business Development. Institute of Chartered Accountants of Nigeria, 2006, Management Accounting.